Hey, good morning, everyone. My name is Ronke Odewumi. Welcome to your Investing Masterclass for beginners. As I said earlier, I'm Ronke Odewumi, and I'm your teacher for today. A little bit about me. I'm a chartered accountant and spent the last 20 years providing management consulting and strategy advisory in financial spaces. I'm married, I have 2 children, and I'm a Christian. You can connect with me via social media, which is where most of you have found out about this class and registered. Instagram, YouTube, TikTok is the same thing. It's Ronke Odewumi. It's a great opportunity to let you know that it is Ronke Odewumi. There is nothing added to it. There is no dash. There is no full stop. There is nothing, because there's quite a few people imitating my account on TikTok. So I needed to mention that. My website has just gone live in the last few weeks, and it's ronkeodewumi.com. You can access resources, blog posts. I write a lot of material and I put on there that you can access to teach. There's a lot of resources that you can purchase, and there are also free resources on my website for you. You can also email me at ronkeodewumi@gmail.com or ronke@ronkeodewumi.com. Both of them work, and I will see your email if you reach out to me via those platforms. This course is going to take about 2 hours, 2.5 hours. So get ready, get a cup of water. I will give you regular breaks as we go. You need to be in a quiet room, have a pen and paper, and I would like it very much if you switch your camera on, because it's an interactive class. You will receive a recording after this class, so you can revisit and revise your learning. And again, you can reach out to me at this email address. If you have questions after the class, you and I are in a learning relationship together, which means I'm here to answer your questions after today. Now, this course is intended to introduce you to key investing concepts and help you explore the benefits of things like compound interest, understanding the various investment instruments out there, how you can get them, what you need to think about when you buy them, and to help you have a robust understanding of investing principles and instruments. The idea is so that at the end of the day, when somebody is telling you to invest in something, you know the questions to ask, you know the tests you need to put that investing instrument through before you decide to put your good money to it. You will learn about the regulated investing instruments that are available to you, that is stocks, mutual funds, exchange traded funds, bonds, and so on. And you will develop the ability to make informed decisions regarding these various instruments based on your own risk appetite. You're already yawning. Guys, get coffee. It's a long journey. We are here. Don't yawn. I will only be talking about regulated instruments. I do not invest in unregulated investments, even though I'm aware of them and I'm aware of the benefits that they can potentially hold. I do not invest in them or teach about them. So you will not be learning about crypto on this journey we are on. We are only here to talk about things that are regulated, protected by governments across the world. Now, it's important for me to mention that this is not a class about budgeting and saving. You are here because you have mastered the ability to save and you have extra money on the side that you are not ready to invest. So we're not going to be talking about your saving skills. We're not going to be talking about your budgeting skills either, because I feel you somehow have control of your funds. Now, if you are still doing your budget in your head, it's a different conversation that you and I are going to have. But we're not going to be talking about that here today. We're not talking about debt reduction either. If you need to have a conversation about paying off your debt, please see me separately. If you need to have a conversation about managing your money, please see me separately. This course is strictly for educational purposes. It's not financial advice. It's not an opportunity for you to start taking screenshots of things that I mentioned and start running off to buy them without doing any research. Please don't do that. The financial market is a volatile market. It's not a put in one and get one out. It's a volatile market. Your investments may grow or they may fall after you purchase them. So it's not for you to buy it and then 6 months later you go, I knew it. I knew it. I knew it. Instagram people, they are lying. No, the financial market is volatile. Your money will rise and fall. And the reason why you're in this class is for me to teach you how to take advantage or how to benefit from that volatility, how to manage the movement of the market so that it doesn't ruin your own portfolio. Nevertheless, you will still need to do research about investing. And at the same time, after this course or after watching this recording again, you are still free to speak to a financial advisor. It is not a cult. You are not restricted from having conversations with other people. Please feel free to have conversation with a financial advisor if you are still not convinced about the investing journey you are on. You cannot have too much advice. Now, this course is for anyone who is interested in managing their money confidently. You want to build knowledge about investing. You have money, but you don't know where to put it. You've opened an account with Trading 212. You don't know what the next step is. Or you have the money sitting in a savings account. You want to do better with it. Or you already have the money invested, but you feel like you've done it wrong. You've done it with the wrong account. You're not sure what you've done. You want to have clarity on that. You want to have knowledge, not just for today, but for the future. Because now you are somebody who has probably done property. Some of you have done property. You've invested in all sorts of things. You have businesses. You want to try something different. And you want to have the right knowledge. You want to have that empowerment to try something different. There is no prior qualification required for this class. It's open to everyone. I've delivered this class to medical doctors and nurses. Why do I mention them? Because they're the people that are renowned for having very poor knowledge of mathematics, numbers, and things like that. And they understood this class and took action. So you will understand this class and you will be able to take action afterwards. So this class is for everybody. Teenagers have attended my class and they've been able to take away knowledge from it and go on and action it, as you will also be able to do as well. Now, first question to the class. What is investing? I need you guys to come off mute and talk to me. What is investing? Do I need to call names? Guys,
Growing your money.
growing your money, okay?
Putting money aside in order for it to grow for the future.
Okay. Anybody else?
Be a long or short-term process for growing your money.
Short-term process. Okay. All right. I have a very smart class because all of you got it right. Because a lot of times some people have different ideas about investing. Well, you guys have a good picture of what investing is. It's growing your money. It's making your money work for you. It's doing it over a period of time. And it's an opportunity for entrepreneurial ownership. When you invest, it's like planting seeds with the hope that they will grow into bigger plants over time, which means one, it needs time. Two, what you put in is not what you want to get out. You want to get more. You don't want to put in one seed, and nobody plants a seed and wants to come back to get one. You don't plant a seed, a mango seed, go away with the plant that when the tree grows, you will get one mango fruit back, because that will make you a mad person. No, you want to reap baskets and baskets of that fruit. But that also means that you are going to wait. You're not going to plant it on Monday and reap it on Tuesday. You're going to put it into the ground on Monday and dig it up on Tuesday. It's very important for me that you take note of the fact that investing requires time. It's making your money work for you. It means that your money is working when you're not there. If you have to put your hand in it, if you have to put your finger in it and monitor it, if you have to be there day in, day out, that's not investing. That's just a job. That's your day-to-day job. You have to show up. If it's a business, you have to show up. You have to be there. You can't be in your house sleeping 24/7. I mean, even if you don't go every day, if you're running a business, you have to show up at some point. So it's not a business, it's an investment, which means you leave it to do its thing. You leave somebody else to run it for you. It's making money work for you while you're not there. And investing into things like stocks gives you ownership of a small piece of a business. Not all of us can be entrepreneurs. Not all of us can start businesses. Not all of us have that kind of energy, time. Some of us don't even like talking to other people. So you can't even do that business, but you can still be an entrepreneur by investing. Because when you invest in the stock market, you become a part owner of whatever business you have invested in. There was a guy on LinkedIn that put on his profile previous jobs or current roles, and he put owner, co-founder or co-owner, Microsoft, and then he put the year that he bought the stock in. Co-owner, Google, he put the year that and he put all these big companies, and recruiters were chasing him around, and then people were complaining that why will he do that? Because he knows the meaning of investing, and he knows that it makes him a co-owner of that business. No matter how small your stock share is, once you buy a stock of a company, you are a co-owner of that business. You own a piece of the pie. It also means that when that company does well, the value of your stock increases, you get a piece of the pie back. You get something, you get rewarded for investing, for believing in that company enough to take a risk on them. So investing is growing your money, it's making your money work, it's entrepreneurial ownership. And I want you to know what investing is, because we are going to talk about the things that are not investing. That is where we're going to fight. When we get to that place, when I remind you that your nice new car is not an investment, or that the renovation you are doing in your house is not an investment, and your shoulder pad will rise. We will get to that point. So I need you to know now, bear in mind that investing means your money will grow, has to grow. That has to be the goal. There has to be a potential and a possibility that your money will grow. If there is no possibility that the £5 you put in is going to become £10, that is not an investment. Now, why should you do it? Why can't you just put your money under your mattress or leave your money in a savings account in trusty HSBC or trusty Lloyds Bank and be done with it? The reason is because inflation. If you put your money in savings or you put it under your mattress, you will not beat inflation. Inflation will come and devalue your money. Inflation devalues money. Let me give you a good example. If you had £10,000 20 years ago and you went to some parts of Kent or outside London, you would buy a flat. You'd buy a flat. You'd have a 10% deposit. £5,000 is a good deposit for a decent apartment in Kent 20 years ago. I know because I know people that bought it. Now, that £5,000, if you keep it in your savings account, what am I saying, Kent? Chafford 100. Chafford 100 in Kent, right there in Essex. £5,000 will get you an apartment. Now, if you put that £5,000 in your savings account and you come back this year, your £5,000 will probably be what now? 6,500. You will have a little bit of money on it because savings accounts are paying you 2%, 3%, and then you're paying fees and all of those things. Now, if you take that 6,500 to a real estate agent and you say, I have 6,500 and I want to buy a flat in Chafford 100, they will look for the camera behind you because you're a prankster. You're a prankster because your money is not going to get you anything. Why? Because inflation has happened to your money. Because the price of goods and services increase year on year. And that is why you invest to beat inflation, to prevent that money that you have now from being worthless in a few years. It also allows you to build wealth. Because the house you bought 20 years ago in Essex, in Chafford 100 with 5,500, rent is being paid off because somebody is living in it or you're living in it. And in 20 years, you can sell it. You've built wealth. If you put your money into the stock market, it's the same thing. You put that £5,000 in fact, the people who put £5,000 in Nvidia 20 years ago, today have about 5 million each, 500,000, 5 million each. That one is a bit crazy. It's an unusual example, but it's to show you that you can build wealth with the stock market. You can also make income because some stocks will pay you dividend. They call them dividend kings, dividend aristocrats. These are companies that pay dividends. Parker Hannifin is a company that has paid dividend every single year for 65 years. Parker Hannifin has paid dividend for 65 years. They have given income to their shareholders for 65 years. They are not in the club of the tech companies that are out there today who don't pay any dividends and are constantly telling you that they're using your money to grow their business. No. Some companies are called dividend aristocrats. They will pay you dividends every year. Investing will also help you meet your financial goals because there are government initiatives that support investing. The lifetime ISA, you put in money, 4,000, the government will add £1,000 to it. That's an initiative that supports investing and allows you to invest and achieve your financial goals. So these are the 4 reasons why you should invest. So the next time your friends ask you, why are you always investing? Why are you not using your money to follow us to Spain? You will give them these 4 reasons. I'm beating inflation, I'm making income, I'm building wealth, I'm achieving my financial goals. Now, there is something that is interesting about investing that separates it from savings. Because why can't you put how can you put £5,000 in a savings account and get 1,005 extra in a few years? But someone that invests is getting double. What is the secret? The secret is compound interest. Okay. If, for example, you have £150 and you put it into an investing account because you've attended this class and you've decided that, okay, I understand what Ronke is talking about. I'm going to start investing, but all I have is £150. And you put your £150 into an exchange traded fund or an index fund or your mutual fund that's giving you 8%. It's not even giving you a lot. You haven't invested too risky. You haven't bought stocks. You've gone for an index fund, easy peasy lemon squeezy, and it's giving you 8%. And every time it gives you that return, you reinvest it. You're not taking out your money. In 15 years, this is what you're going to have. You would have put in 9,000 years in 5 years. You see, £150. You're looking at it and thinking, it's not a lot of money. What's £150? But in 5 years, you will have put in £9,000. But your portfolio value will be 10,351. So you will have made an extra 1,351 in 5 years. It's not a lot. You're thinking even savings will give me half of that. Okay? Savings will give you half of that because it's 4%. Let's go. And in 10 years, you are putting 18,000, but now your money is 24,869. You've gotten an extra 6,000 plus. There's no savings that's going to give you that. Why? Because your interest here is earning interest. That is the secret of compound interest. Your interest is earning interest. So it's not just the money you put in. The money you put in that earned interest, that interest too starts to earn interest. So that in 15 years, your money literally doubles. That is even at 8%. There are investments that will give you more, and you will meet them as we go on this journey. Now, how do you start investing? You know what investing is. You know why you should do it. You've heard about compound interest. But how? Because the how is the reason why all of you are here. This is the how. This is it. It's very simple. It's very straightforward. Don't let anybody confuse you. You choose an investing platform. You open a tax-efficient account. If you're in the UK, I will tell you which ones you open. If you're in the US, I will tell you which one. If you're in Canada, I will tell you which one. Do we have anybody here who is from the US? No? Do we have anybody from Canada? No? Super. Okay, so we're all UK people. So you choose an investing platform, you open a tax-efficient account, you think about the different assets you want to buy. You need to ask yourself, am I buying stocks? Am I buying bonds? Am I buying exchange-traded funds? Is it mutual funds? Is it REITs? What am I buying? Then you choose your investment, you place the order, you rinse and repeat. The trick with investing is consistency. Consistency in spite of results. Consistency in spite of the market. Consistency in spite of the economy. Consistency in spite of how you feel. Consistency in spite of what you have. Consistency in spite of what you are going through because you have a goal. That consistency is what put 6 figures in my investing account. When I hit a particular figure, which I'll tell you later on in an investing account, I open a new one. Today, I'm on my 3rd account. Investing despite whatever life throws at you. You have to be consistent. So these are the steps. Now we're going to go through the steps in detail. Because if I tell you to choose an investing platform, you're thinking, which one? How? How do I know which one to choose? Which one is best? That's the question I get the most. Which one is best? There is no best. But I will tell you the criteria you need to consider to choose your investing platforms. What are the tax-efficient accounts you can open? What do I mean by tax-efficient account? If you invest in an account that's not tax-efficient, King Charles is waiting for you with his team to collect their share. Different assets have different risk levels, and you need to invest according to your risk level. Because if you use my risk level to invest, or you use only today's risk level to invest, when that risk level starts to perform, you will carry your Bible and you'll be rolling on the floor, and you'll be going, Jesus, Jesus, Master Jesus, Master Jesus. What Jesus cannot do does not exist, because you've done past yourself. And so you must use your own risk tolerance level, where you are on the risk profile. That's where you invest. If you are somebody who has low risk profile, there are assets for you. You don't like stress. You don't like your money to change color. You like to put in £2 and come back and find your £2 creeping up quietly, and at no point is it giving you 50p. You invest like that. There are some people who are in the middle. They like they don't mind if their investment is shaking a little bit, because they know that in a few years it will recover. You know yourselves. There are things for you. And then there are some people who are very much, the Lord give it, the Lord take it away. Today is here, tomorrow is not. If I make it, what's the big deal? There is a group of investing for them. They invest like that. We will get there. Now, investing platforms. This is the first level. Choosing your investing platform. What are they? Investing platforms are fund supermarkets where you can buy investments, sell investments, hold investments all in one place. And they are designed for you to make your own investment decisions. So they are execution-only platforms. Think of them as Tesco, Asda, Sainsbury. That's the example. Imagine that you go into Tesco or Asda to buy groceries. One, you have your own shopping list. If you have been listening to me, you have a budget. You know how much you have. It's not an endless pot. You go into Tesco or Asda because you've had food, you've eaten, you're in a good frame of mind. You go in with your shopping basket and you start to shop. Now, when you go into Tesco, imagine that while you are there, one of the Tesco staff starts to follow you around and says, buy oranges. No. Don't buy that. Buy this, buy that. Are you not going to leave the store? You're either going to leave the store, you're going to attack the person. What is going on? Why are you following me? I know what I want. That is the same way fund supermarkets are. There is nobody telling you what to buy. You go in, you buy by yourself. It's a simple buying process. There is easy access to different assets that you can buy. Each investment platform sells different kinds of assets, and they will tell you, if you log in, which you are going to do, they will show you this is what we offer. So you see what they offer, they tell you what you have to buy, you buy it. There is little or no paperwork after you've registered. That's it. You can buy investments in 5 minutes. In fact, if you tell me to help you hold money and you don't come back quickly, I've invested it sharply. By the time you come back, I'll tell you, let me go and liquidate. Give me 5 minutes. I will liquidate for you, but I will clear out my interest because something has happened to your money while you were gone. Because it's very straightforward. It's very easy. You can do it. There is little or no paperwork. The fund supermarkets allow you to invest. You can buy stocks, you can buy funds, you can buy bonds on all of these platforms. Some platforms sell some things and some platforms don't sell some things. Now, I said earlier that they are do it yourself. You have to go in and choose your own assets. Some of us don't have that energy. We don't have the energy, we don't have the time, we don't want to do the research, we don't want to, we have decision paralysis. This is where robo advisors come in. Robo advisors invest on your behalf because they use an algorithm. You don't have to choose anything. You don't have to think about it. You just register. You answer questions about your risk tolerance because they want to know if you're rolling on the floor with Jesus or if you're a hasta la vista kind of person. So they will ask you questions. And once they know your risk level, once they know where you sit in the risk profile, it will invest for you. And you don't have to do anything. You just have to put in money regularly. It's fully automated. They manage your portfolio. They tell you how much your money has grown anytime you log in. They even offer themed portfolios. If you want to invest in just ethical investment, you don't want all that oil and gas rubbish that's polluting the environment, or maybe you want just tech, they will do it for you. These platforms exist and they do the job. There is Wealthify, I think that's in the US, and Wealthsimple. There is Nutmeg and Money Farm in the UK as well that you can use. I have used Nutmeg. I continue to use Nutmeg. It's fantastic. They invest for you. There is no work. You just put money, it's invested for you. Most of the time, they are invested in index funds. Your money is invested in index funds a lot of times. Now, the downside of robo-advisors is that there is limited personalization of your portfolio. The same portfolio they give you is the same portfolio they're going to give other people who have the same risk profile. You can't manage your own portfolio. You can't hear about something and say, oh, because I'm a doctor, there's this drug I prescribe all the time. Oh, and it's produced by Bristol Myers Squibb. I'm going to go and buy Bristol Myers Squibb's. No, you don't get to choose. They choose for you. They are they are no longer new as they should be. They've been around for quite a while, so maybe I shouldn't say they are relatively new and untested compared to the stock market and other investment platforms. Yes, but they're not that new because I've had an account with a robo advisor for over 8 years now. So honestly, I cannot say that they are that new. So Nutmeg is one I use. Money Farm is another option that you can use as well. So if you are somebody who wants to invest with an investing platform and you don't want to choose your own stocks, you don't mind that AI is choosing for you, then you should consider robo advisors. Now, what are the things you need to know before you choose an investing platform? You need to think about the fees. Some platforms charge more fees than others. They will charge account maintenance, they will charge trading commission, they will charge all sorts of things. You need to be aware of the fees. One of my favorite platforms is an expensive platform. AgriLansdown will charge you. Every time I buy stocks on AgriLansdown, they charge me £11. If I buy a lot of stocks this month, the next month they will charge me £7. If I buy a lot of stocks in that next month, in the next month they will charge me £5. But otherwise, it's £11. Unless you are doing a lot of trading, AgriLansdown will charge you. There are benefits to their platform. It is sleek. It is easy to use. They sell everything under the sun that is regulated. There's nothing I want to find I won't find on their platform. I have never looked on their platform and found that it broke down. They couldn't log in. Maintenance is going on. They do that at 2 a.m. And I've logged in at 2 a.m. sometimes and I was still able to log in. So for me, AgriLansdown offers that, but the fees are high. If you are looking for a low fee platform because you are someone that invests £100 monthly, then you want to look at Vanguard, you want to look at Fidelity International, you want to look at Trading 212. Why? Their fees are lower. Free trade as well has low fees. You need to think about what is the investment and account options. Some of them will say, oh, you can invest for free, but not with a stock ISA. If you want a stock ISA, you pay more fees. Some of them will tell you that they don't sell stocks. Vanguard and Fidelity International only sell their own products. If you go on Vanguard, you only find Vanguard products. You won't find any other product on the Vanguard platform. Vanguard only sells their product. You need to bear that in mind. Some will only sell ETFs and they won't sell stocks. Some will sell stocks, but they won't sell US stocks because they don't want to put you through filling the WeBend form. So you need to think about the range of products a platform offers. You need to think about platform security. Does it have encryption? Does it have two-factor authentication? How do you log in? How easy is it for you to log in? How safe is your money? Are they regulated? This should be number one. Are they regulated by a financial body, e.g. FSCS in the UK? Do you have FCA protection? If a platform is not regulated, because of you guys, I pushed my husband down this week. I push him down. If you go on my Instagram, you will see me pushing him down. I'm helping him to fall. So that you people can see that if you use a platform that's not regulated, that's how you will fall. And when he was going to fall, I didn't tell him, oh, yeah, I'm not going to catch you. No, I said, come and help me do a video to show my people how pension catches us when we are in old age. This is how pension catches us when we do pension. So when you fall, I will catch you to show everybody that our pension will catch you. This man trusted me and he fell. What did I catch him? I didn't catch him. I allowed him to fall so that people will see that if you don't use a platform that is regulated, that's how your life will scatter. That's how you will fall. So you need to use platforms that are regulated so that your money is protected. In the UK, your money is protected up to £85,000, which means if the platform collapses, the UK government is obligated to give you your money up to £85,000. And this is my limit on most investing platforms. Once I invest on a platform and my money hits 90 grand, 100 grand, I move. So I have a platform now that I have money on that I cannot invest in again because, in my own opinion, I have exposed myself to the limit to which I am covered. I've moved to the second platform, exhausted it, I'm on my third platform. So you need to bear that in mind when you are investing. You need to think about accessibility. Is there a mobile app? Can I look at it? Vanguard is one of my favorite platforms, and for years, it didn't have a mobile app. Just last year, towards the end of the year, it was our best Christmas present. Vanguard introduced a mobile app. You still can't do a lot on their app, but you can see your money. You can see where your money is, what it's doing. You can log in and just have that kind of access. AgriLasDown mobile app is excellent. It's flawless. That's what you're paying for when you pay that fee. So you need to think about mobile accessibility. Some people like not having mobile access because that way you are not selling and buying willy-nilly. You don't want to keep logging in anyway. It's not a good habit to log in every week to see what is happening because then you will sell. I've done it before. Many years ago, I was the queen that would buy and say, I sold Netflix. You will not want to understand how much I bought the Netflix that I sold. Because when I bought the Netflix, I think it was £90 per unit. Because Netflix is rocking up to $600 now per unit. And I sold it when it dropped to like maybe £80. Like, this thing has dropped. Netflix, who is even watching streaming service when we have Sky? I sold Netflix. That's what happens when you are logging in willy-nilly. Research opportunities, research and tools. Some platforms offer research. They offer so much research, so much information that you can live on those platforms. You can get everything you need. You can read information. You can read material. I'm reading them. You can read them as well. I don't make up my knowledge. I read. Some of us don't want to read, but you have to read. If you want the knowledge, if you want to know what is going on there, some platforms offer that. And if you want that, then you can choose to go for a platform that offers that. Do we want a break or should I keep going?
You can keep going.
Keep going.
Any questions so far?
Keep going now.
Any questions?
Just one.
Yeah.
With the banking guarantee from the government, is that on
Who's talking? I'm not sure who's talking.
It's Dr. Bello.
Okay.
With the banking guarantee from the government, the 85,000.
Yes.
Because I've heard of it before, but is that on individual banks or is that your total amount in all your banking or all your?
No, per bank.
Okay.
Per platform, per anybody that has the FSCS protection, which is why I said when I open an account with a platform and my money hits 90K or 100 or even 85,000, I just leave that money. I move on to another platform again because now I'm taking advantage of that 85,000 somewhere else. I mean, it's not like all of them will crash on the same day. And remember, the protection is not for if the value of your money drops because you invested in foolishness or you invested in something that's not working. It is if that platform or bank declares bankruptcy.
Yeah.
Exactly. Good. Yes, Deolu has a question.
Hi, sorry. You just mentioned if that you have to read and you have to do your research before you buy any of. Could you highlight? So if I say I want to buy an ETF now, so what are the things I should be looking at before I commit? So say if I'm reading about a company, so what are the pointers that
Okay.
should be enough for that we say, okay, this is a good one to go and this is
Okay.
a bad
So,
one not to.
all right. So when it comes to the company, what you are looking for is different from when it comes to a fund. Okay. When it comes to a fund, you want to look at what the fund is invested in. You want to look at how many companies are there, what sectors the fund is covering, um, how the fund has performed over the last few years. These are the things you want to think about if you are investing in a fund. Is it an index fund which is tracking a specific index, or is it a mutual fund that has a manager? What are the fees that the fund is charging? Because fees do rack up. So those are the things you want to think about when you look at a fund. It's easier with a fund. You're thinking about fewer things because somebody has done the job of putting them together in a basket. I'm going to get to that when I talk about the different instruments you're going to invest in. Now, when it comes to stocks, you need to look at the historical performance of the company. You need to look at who the CEO is, what industry the company is in, and what is the market trend for that industry. Is it an industry that's doing well or is not doing well? For example, the automotive industry is not doing well right now. So you need to think about that before you invest in Ferrari or you invest in Porsche or Ford. You need to think about the skill set of the leadership of that company. What are they doing? How are they leading the company? What is their own experience of leading the company? How well have they led the company so far? Now, when you think about all of those soft ones, then you need to think about the financial metrics. And this is the one that gets a lot of people down. I did a whole spreadsheet, which is on my website, that you can download and you can plug in the company, plug in these financial metrics, and my spreadsheet will tell you this is a good company, this is not the company you want to buy right now. I have that spreadsheet. Now, the metrics that I usually use, which is also in my spreadsheet, are things like revenue growth. How much is their revenue growing year on year? What is their profit margin year on year? What is the return they have on equity, which is the return they have on investment by shareholders? What is their debt to equity ratio? How much of that company is being run on debt? What is their price to earning ratio? What is their free cash flow? Cash is king. Do they have money? Do they have cash? What is their earnings per share? How much can you expect to get per share from this company? What is the dividend yield if it's a dividend paying company? What is the operating margin? What are they using to run the company? What is the current ratio? What is their contribution margin? What are they using to finance their fixed costs? These are numbers that are actually available online. Websites like stockanalysis.com will give you the number if you type in the company. Morningstar will give you these numbers if you type in the name of the company. They will give you the numbers that are available online. Stock analysis is funny because they will not just give you the numbers, they will give you what analysts have recommended about a stock. They will tell you, these are the numbers for this particular company. This is what the stock analysts are saying. 10 analysts are saying buy, 2 analysts are saying sell, 1 analyst is saying hold. If 20 analysts are saying sell, please, why are you buying it? You need to ask yourself that. You need to have some additional information that will make you do something different from what analysts who spend their days looking at those companies are talking about, are saying. So there are platforms like that have made the job easy, and there are metrics like that, and there are spreadsheets like the one I have that you can use to make your decisions about whether you invest in a company or not. Again, that is why if you don't want to do the hard work, you do funds. If you don't want to do the hard work of funds, you do robo-advisors. There are levels to, there are provisions for every level of investing that you want to do. Now, the investing platforms in the UK, this is a good list. I have here 11 investing platforms that I think are decent. PJBL, Agris, Trading, Moneybox, Fidelity, Vanguard, Barclays, Halifax, Nutmeg, Wealthify, and Money Farm are these investing platforms. The last 3 are robo-advisors. So if you invest through them, you don't get to choose what your money goes to. Now, with some of these platforms, Trading 212, for example, and eToro, while they are regulated and they sell investments, I personally find them very busy, very distracting, because they are also trading platforms. People can go there to trade Forex. So there's a lot of activity going on those platforms, and I'm generally wary of them. I registered on 2212 briefly for a few months, and I couldn't cope with the level of activity that was going on there because I don't trade and I didn't want to do all of that. So bear that in mind when you choose your platform as well. Choosing a platform that is easy for you to navigate is important. It's very important than choosing a platform because everybody's using it. No. So choose a platform that is easy for you to navigate. We don't have US people, we don't have Canada, we don't have Nigeria. Fantastic. Okay, so tax efficient accounts. Now, before I go on, in the chat box, can we all type in if we all have investing accounts, investing platforms, if we are registered on them? Can we type in very quickly in the chat box which platform you are registered on? And if you have not registered on any platform, which platforms you are thinking of registering on? The spreadsheet is called invest company assessment or investment assessment tool. Let me confirm it. Now there is the option to buy my investing for beginners book, which is this whole recording or this whole program as a book. There is the option to buy that. So you can buy that for people that you love. You can buy that for yourself to have. Fantastic option for you if you're a reader. Please go ahead and look at that as well on my platform. Odewumi.com is there. Investment assessment tool. That's what it's called. Investment assessment tool. Thank you, Emmanuel. Emmanuel has dropped a link in the chat for us. So if you would like to take advantage of that, please take advantage of the link as well. I will drop the whole website in the chat again, ronke.com, so that you can access that if you want. Okay, Gracious Hargreaves, okay, Trading 212. There are quite a few people on Trading 212, okay. Agris Lasdown, Itoro. Yes, you can have more than one. So if you're already on a platform, you don't have to have just one platform. Like I said, I have more than one. You can have more than one platform and invest through more than one platform as long as you align with the rules, which I will tell you now when it comes to the accounts that you need to have. Okay. You want me to talk about Nigeria platforms, even though you are not there and you want to explore it? You are not sure yet, which is why you are in this class. Yes, I want you to decide. I want you to think about what I have told you today. Go and explore those websites and decide, because that is a blocker for a lot of people. You just don't decide and then you don't do anything. I need you to go and do homework and decide, and then tell me which ones that you have decided on later on. You can send me an email, you can send me an Instagram message. Please decide. All right, you want to know about the platforms in the US and in Nigeria. Okay, let's go back to that then. Okay. So in the US, you have Vanguard, Charles, Fidelity, Robinhood, Interactive Brokers, Ally Invest, Wealthfront. In the US, there are also investing accounts that you can use if you are employed in the US. There is the 401k or 403b, which is the employer investing account. I will talk about that later if you want to hear about it. And then there is the Roth IRA and the traditional IRA for my US people that you can use to invest. And then there is the brokerage account, regular brokerage account that has no tax efficiency. You invest through it, you make money, you pay tax, period. Now, with those ones, you can use any of these accounts. With your Roth IRA, you can use these platforms as well. With your traditional IRAs, you can use these platforms as well. The same rule applies in the US with regards to robo-advisors. If you use a robo-advisor, you will not be able to choose your investment in the US. All of these platforms I have provided here are regulated and protected by the FINRA or the SEC. So they are safe platforms and they have Financial Industry Regulatory Authority protection. So this is for the US. Now for Nigeria, very interesting country, the investing platforms there are protected by the CBN. They are regulated by the SEC, and some are also protected by the CBN, such as Kuda Wealth. There's Cowrywise, there is Wealth.ng, there is Kuda Wealth, there is Chaka, Bamboo, Trove. Now, with Trove, I was not able to confirm their regulation. They might be, I'm not saying they are not. I was not able to confirm it. There is also something called Afri Invest in Nigeria, which you can also use to invest in Nigeria if you are investing in Naira. Some of these platforms allow you to only invest in African stocks. Some allow you to only invest with Nigerian stocks, but Bamboo allows you to invest with global stocks. So that's what bearing in mind. You get opportunity to get mutual fund, fixed income securities, and other investment products. The good thing about a lot of the Nigerian investing is that they have higher interest rates, but you have to bear that in mind as against devaluation of the naira, which is a constant activity. Okay. So we have that. Okay. Okay. So tax efficient accounts. So that also means that when I talk about tax efficient accounts in the UK, you want me to run through the tax efficient accounts in the US as well. Is that what you guys want? Do we have people who want to hear about the tax efficient accounts in the US? Okay, good. I will run through that as well. So we talked about choosing an investing platform. We now want to talk about the tax efficient accounts in the US. The most tax efficient account in the UK that is available to every UK resident is the Stocks and Shares ISA. So that's the first one I'm going to talk about. The Stocks and Shares ISA is an individual savings account for investing, which the UK government has allowed all of us to have, where we can invest as up to £20,000 of our tax-free allowance. Every financial year, you and I get £20,000 tax-free allowance, which is how much we can put into any of our individual savings accounts or our ISAs. Now, there are different kinds of ISAs. There is a stocks ISA, which I'm talking about now. There is the cash ISA, which is a savings account. There is the lifetime ISA, which is another ISA I will talk about. Now, your allowance of £20,000 each financial year is across all those accounts. Let me explain. You don't have 20,000 for stocks ISA, 20,000 for cash ISA, 20,000 for lifetime ISA. No. You have 20,000 across all three, which means if you put 4,000 into your lifetime ISA, you only have 16,000 to spread across the remaining two. If you put 4,000 in cash and you put 4,000 in lifetime ISA, you only have 12,000 to invest in your stocks and shares ISA. You can do this stocks and shares ISA across platforms. You can have more than one. Many years ago, you could only operate only one. Not so anymore. You can actually have more than one stock and share ISA account, and you can withdraw anytime from your stocks and share ISA account. But you have to bear in mind that once you withdraw, you don't get that allowance back. You've used it. If you bring back the money, it's still going to use more of your allowance. Let me explain. So if you put 2,000 in your stocks and ISA allowance account, which means you have only 18,000 left, and you come back tomorrow and remove that 2,000. When you put it back in, you have used another 2,000. So now you have 16,000 left. Nobody's going to say, oh, it's the same 2,000 she had before that Elizabeth brought back. No, it's not the same 2,000. As far as they are concerned, you have used more of your allowance. All returns on this allowance is tax-free. You don't have to declare it on your account. You don't have to declare when you do your yearly accounting or tax returns. It's completely tax-free. The platform will inform HMRC that Olutide with this so NI number has used this portion of his ISA allowance, of his stocks ISA allowance. Tobi Odeleye has used £5,000 of her allowance, and she didn't use 15,000 because she was busy buying wigs. They will inform them of how much of your allowance you have used. Now, this allowance is only per year and you cannot carry it over. So there is no carryover of this allowance. If you don't use it, you lose it. So you have 20,000 every year from 6th of April 2024 to 5th of April 2025. So this year now you have a little over 1.5 months, 2 months to use up the allowance that you have. Once you don't use it, a new allowance kicks in on the 6th of April. So if you have £20,000 stashed somewhere that you haven't invested, this is the opportunity to use that allowance quickly before the 5th of April, because the new allowance kicks in on the 6th of April and you have to start all over again. Do we all understand what I mean by the stocks and shares ISA account so far?
Yes.
Thank you.
I have a question.
Yes, I have a question.
Okay.
So this 20,000, is it all banks, as in, like if you have Lloyds, you have Halifax, can you do 20,000 on each account, or is just one account that you are able to do 20,000 for the whole year?
Okay, first of all, forget banks. I'm not talking about banks. These are investing platforms. You are investing, you're not saving. Saving is banks. You are investing. Your allowance is tied to you, not to the platform. So if I have two platforms, and I open a stocks and shares account on both platforms, I still have just 120,000. So if I use 10,000 on Agrives, I have only 10,000 left to use anywhere else on any other stocks or cash or LISA account that I might have. That 20,000 pounds is an allowance that is tied to you as a person and your NI number. It is the allowance that you have, not the bank, not the account. So if you have 10 accounts, you have to find a way to make sure that if they add up all the monies in the 10 accounts, it doesn't exceed 20,000 pounds. Does that make sense?
Okay, yeah.
Yeah,
Any
I
other
have a question.
questions?
Yes, please. Okay, so since that the current tax year is just about 2 months to go or thereabout, if I open an account now and I move say 4,000 into my lifetime ISA,
Yeah.
will do I still qualify for the for the is it interest now or
Yes,
what's that called? Yes, that comes only without any sanction or penalty.
there is no sanction.
Yeah, since that I just moved the money into it towards the end of the tax year.
If you put your 4,000 pounds in on the 1st of April, you will still
Okay,
get 1,000 pounds from the government.
all right.
Yes. In fact, I know
Okay.
people who put money in on the 3rd of April and they still got their money. You will get 5th of April is risky. Don't wait till the last day. But try and get your money in March or in February so that you get your allowance quickly and you can start prepping for the next financial year. Okay. So that is the first ISA account I'm talking about today, is the stocks and shares ISA. And this is the one we are all going to invest with. Now, when you get to your
Can I ask a question
platform,
quickly, please?
yes, please.
Regarding the ISA allowance, is this inclusive of junior ISA? Because I have junior ISAs for my kids.
But that's your children. I just said your ISA account is tied to you.
Yeah, okay.
It's an identity thing. So it's tied to you. It's different from your children's own. It's different from your husband's own. It's different from your boyfriend's own. You have your own 20. Every adult in the UK gets 20 grand. The children get 9,000 pounds each. So it's very important. Now, some of us, we are sneaky. We will say, how will they track it? How will they track it? Then you will use 20,000 pounds and then open another one and use another 15,000. No, please don't do that. It will take time, but HMRC will figure it out and they will write you that letter and it will mess up your accounting because they will decide at some point that you have made some amount of money and you should not give them a big share of it. So it's very important that you stay within your ISA allowance per year. Now,
Sorry, with the ISA allowance, is there age limit to that?
not for the stocks and shares, which is why I said it's open to every adult in the UK that is resident and tax resident in the UK, no restrictions. Now, this is the ISA account that has restrictions, which is why I said the stocks and shares ISA is the one we are going to invest in first. Let me go back to this account. Now, I was going to say some platforms are super sneaky. They will tell you that they have an account called Investing Solo Account. That's not an ISA. Red Revolut has something that they named in a way that if you abbreviate the name, it's ISA, but it's not an ISA account. So make sure that the account you are investing with says stocks ISA or stocks and shares ISA. It has to have that in his name, stocks ISA. If it says general account, it's not the one. If it says fund and share, it's not the one. If it says fund it yourself, it's not the one. Individual investing, people carry it over, that's not the one. Stocks ISA account. You'll be surprised how many times I get this question. Is the stocks and shares ISA account? Is the stocks ISA? I've shown you how it's written on different platforms. See, PJ Bell, stocks and shares ISA. Fidelity, stocks and shares ISA. Agrives, stocks and shares ISA. Some people will even say stocks ISA. It's still okay. Once the name is not clear to you, it's not the one. Now, lifetime ISAs are also ISA accounts with which you can invest. There are two kinds of lifetime ISAs. You can have the cash lifetime ISA or the stocks lifetime ISA. The stocks lifetime ISA you open on investing platforms. The cash lifetime ISAs you open with banks. So if you open a lifetime ISA with a bank, it's a cash lifetime ISA. It's a savings account. You put in £4,000, which is the maximum you can put in. The government gives you £1,000. They give you 25% of whatever you put in. So even if you're only able to put in £1,000, the government will give you £250 on top of it. If you're only able to put in £100, the government will give you £25 on top of your £100. So you will get 25% of what you pay in. It's tax-free as well. Now with this lifetime ISA, that is stocks ISA, that 4,000 you put in addition to getting the £1,000, you can invest it. So instead of the £4,000 just sitting in the cash lifetime ISA, which is what it does in the cash ISA, it just sits. In a stocks ISA, you can invest it. So that £4,000 and the £1,000 from the government, both of them are now working for you and making more money for you. Now, you can only open a lifetime ISA, whether it's cash or stock, if you are between the ages of 18 and 39. So if you are like me, the ship has sailed. You can keep paying in and receiving the bonus until you turn 50. So if you decide that you don't want to buy a house, you're going to use it for retirement, you put in 4,000 every year. The government will keep putting in 1,000 every year until you turn 50. So if you open it at 35 and you do it till you're 50, you're going to get £15,000 from the UK government. And it's not public funds. So if you have children who are 18 years old already, open it for them. Let them start putting in money. Because the government has not cancelled this account here. At some point, they have talked about cancelling it repeatedly. They're going to cancel it at some point. If they allow people like him bad enough to get it, they'll cancel it. And then the other account will not exist anymore. So you need to take advantage of it while you can. You can only take money out of this account for two things: to buy your first home or to retire at the age of 60. You cannot take out that money for any other thing. If you do, you will pay back the government's money. That 25% they gave you, they will collect it back with interest. So bear that in mind as you open the account. If you already own your first property, you need to ask yourself if you want to have this as a retirement account, which is not bad. I'm just letting you know that this particular retirement account, you cannot withdraw from it before the age of 60. Once you turn 50, you can't add any more money to it. So whatever is there will just be growing by itself. You can't add money. The government can't add money. Once you turn 50 for 10 years, what is there is what will be there. You will not be able to take it out. And then when you turn 60, you can start taking out the money completely tax-free. Do we understand what the lifetime ISA is?
Yes, but just to clarify, so for the children age 18 or in general, is this only applicable for the first property they buy?
Yes.
Okay.
It's first property for everybody. This is intended to help us get on the property ladder. So if you've already bought a first property, not a problem. It can be a retirement account.
Okay.
But if you haven't bought a first property, it's a great one for buying a first property, because then you can put in money. And when it's time to buy the property, the money will go from that account directly to the lawyer or the conveyancing lawyer or the mortgage provider. It must not pass through your hands. You don't go and withdraw cash at the machine with this account. The government will take back their money, because that way there is no proof that you used it to buy property. Okay. So the next tax efficient account. So I'm taking it in levels because you can see that the stocks and shares, tax-free, no limit. Lifetime ISA, there is some limit, but the 25% is delicious, is there, it's a good option. The third one is the self-invested personal pension account. I only use this account once I've exhausted my £20,000 allowance. And that's because it's not tax-free. It's not completely tax-free. When it's time to withdraw it, you will only get 25% of it tax-free. So if you have £100,000 in it, they will allow you to withdraw £25,000 tax-free. The remaining 75 will be taxed at whatever tax band you are on at that time. Now, you can only access it from the age of 55. So any money you put in doesn't come out. Once it enters, that's it. It's gone. It stays there until the age of 55, rising to 57 from 2028 is when you can withdraw money from it. Now, this account is a particularly good account because it can be a tax saving account. So apart from the 25% tax-free later on, if you are somebody who works as a contractor or you are a company owner and you have a limited company that pays you a salary every month, that company can pay into your SIP. And there is no limit, literally. So your company can be paying you £40,000 annually and paying £40,000 into your SIP as well, which also reduces the tax burden for that company because that payment is considered an expense. So your company will only pay tax after this has been removed. It's a great way to reduce your tax bill. However, if your company is paying you minimum wage, £11,000, your company cannot put 100,000 into pension for you. They will apply the law of practicality or sensibility to it. Like if a company is paying an employee 11,000, why would the company pay 100K into a pension for that same employee? You are literally a minimum wage employee. So they will say that you are trying to defraud the government of their right to tax. So you need to be careful of how much your company pays into your SIP, but your company can pay quite a decent amount into your SIP. Some people's companies pay 60 grand into their SIP. Yes. Now, this allowance for you is also 60 grand. That is how much you can pay into your own pension. So even if you and if you earn over 100,000 in your employment, you are an employee, not a company, you are an employee, and you have already hit that 100K dangerous band, you can go to your employers and ask them to make payments into your pension. They will which will reduce your take home considerably and bring you into a lower tax band. So you can use that to reduce your tax. You can also then get additional tax relief because anything you pay into this SIP, the government will add 20% to it. And if you have an additional tax relief, the government will even add even more into this account for you. So this self-invested personal pension account is a great way to reduce your tax bill if you are a high income earner. Okay. Before I give us a break, because I need a bio break, I want us to go through a few of these websites so that we can see what I mean by tax efficient accounts, and we can see what the websites look like. I've seen that quite a few people have Agrives and Trading 212, so I will look at those two accounts today. Deolu has a question.
Yes, thank you. Sorry, back to the SIP. It's a bit confusing. So if you are in unemployment, yeah, and you already have a pension account with the company that is doing very well, and having SIP on the side, would they still be able to contribute into your SIP if, for instance, you say, okay, let's say what you are paying out of your salary towards your pension, it's a certain percent, let's say 10%, but you thought, okay, you want to do more. But rather than staying with them, you want to divert it into your SIP. Is it something that is possible under the law?
Yes. You can ask your employer to contribute to your self-invested personal pension, but whether they agree or not depends on your employer's policies. Some employers will agree to contribute into it instead of your workplace pension scheme, or they will agree to contribute into it in addition to your workplace pension scheme. Some employers are open to this and they don't mind. So you have to ask to find out. And it's some employers offer salary sacrifice. So you agree to a lower salary in exchange for higher pension contributions, which are then paid into your SIP. So that salary sacrifice allows you to reduce your tax band so that you fall out from the higher tax band and you fall into a higher tax band instead of the additional tax band that you would get if you were earning over 100 grand. It reduces your income tax, it reduces your NI contributions, it's more tax efficient for you and the employer. Some will only allow you to do salary sacrifice if you pay that sacrifice into the workplace pension scheme. They will say they won't pay it into a SIP. They will only pay that salary sacrifice into your workplace pension. So this is a conversation you need to have with your employer.
All right, cheers, thank you.
Any other questions before we go?
Yeah. Sorry, hi. I dropped a question on the chat regarding lifetime ISA. Just a bit. So if, for example, you wanted to put some money in for your children and they're quite older, and you obviously it's a bulk amount of money. How does that work? Can you put that bulk money and then you still get the 25%? Or
as long as it's not more than £4,000, yes.
Oh wow, okay. All right.
The limit is £4,000.
All right.
Did I just answer a question from a buyer or me, or is it somebody else?
Yes.
I just want to ask that it's only on lifetime ISA you can get the 25% bonus. Right?
Yes. 25% bonus is only on the lifetime ISA, which is why they also limited it to £4,000 because 25% interest on any investment in a year,
Yeah.
solid money. That's why, because if they didn't limit it, why would I go and do stocks and shares ISA if I know that all I have to do is give the government money and they will give me 25%? I will go and sit there and forget any other investment. So they limit it to £4,000.
Okay, and Ronke, just to reconfirm,
Can I
that's
ask
minus the 20K.
Can I ask that you mention your names when you ask? Because I'm not sure who I'm talking to. Please.
Yeah, hello, Ronke. This is Adiola.
Okay.
For us that are over 40, we didn't do the ISA for our kids before we clock 40. What can we do? Though they have the junior ISA accounts, but in terms of investments, they've missed already. So what can we do to measure up for them?
For your children,
Yes,
are they
please.
over 18?
No,
If they are not over 18, then they can still have a junior ISA.
they do. What's the maximum you can put in the junior ISA in a year?
£9,000.
£9,000. And what's the interest rate, please?
There is no fixed interest rate. It depends on what you buy.
Okay.
Yeah.
No, we're doing it with the bank.
So if you are doing a junior ISA as a cash ISA, the bank will tell you what interest rates they have. So you check with the bank that you are doing it with. Some people will give you 4%. Interest rate has dropped again. It's 4.5 now. So you see what it will give you. If your children are close to 18, then a cash ISA is better, because it's at that point they can get cash. But even if they are close to 18, if they are not going to need the money on their 18th birthday, then you can do a junior stock ISA for
Yeah.
them, because when they turn
Okay.
18, you
Yeah,
roll
because
to
what
an
I
adult.
thought, okay.
Does that make sense?
Yeah, I'm listening.
Yeah, when they turn 18,
Yes.
junior stock
Okay,
ISA
my daughter
roll.
is 16.
Yes.
Okay.
So if she's 16, if you open a junior stocks ISA
Junior,
for her,
yes.
when she's 18, it will roll into
Right now? Oh, okay.
It will roll into an adult ISA.
Okay.
Yes.
So I should go to the bank and ask them that I want to open junior stock ISA for her.
I'm going to repeat this again.
Okay.
Banks are for savings.
Yeah.
Anything investing platforms. So if you want to open a junior stock ISA, where are you going to go?
A platform, investing platform. Okay. Right.
Good. Now, some banks have started offering investing. So you might get to Lloyds Bank and find that they're offering investing. I don't advise it. Why? Because it's limited. What they're offering is limited because that's not their primary job. So if you want to save, if you want to open a cash ISA or a cash lifetime ISA, definitely go to the bank, go to big banks, check who has the best interest rates, go for it. But if you are opening a stocks ISA, I will pick investing platforms any day.
Okay.
Yes.
Okay.
Thank
All right.
you. Any other
Thank you.
questions before I move on?
I
No?
have a question. Sorry, my
Yes.
name is Tess. I want to ask about the SIP account. So do you advise that people should merge all their pensions into one? Is that safe? Or it's okay to leave them in multiple places, you know?
Options are safe. You can leave them in multiple places. You can combine. It depends on you. It depends on how much is in the pension. If your pension is 500,000, would I put all of them in one place? No. But if my pension is 5,000, 10,000, 20,000 in 10 places, will I combine it? Yes. Because sometimes pensions are lost. There are over £1 million of pension lost in the UK because people who own them, they don't know that they're there. They've not checked them. The people have lost pensions. People who do contract roles and do pensions in those roles just jump from role to role and they don't carry their pensions with them. So it's an option to combine your pension. I combined my pension over a period of years. I didn't combine all of my pensions, but I combined my pension so that I have pension in like two places now, or 3 places at most, because I don't want to look for 20 different pensions when I'm 60.
Okay, thank you.
Yeah. So shall we go web surfing? Are we ready? Okay. Bear with me.
Apologies, Ronke. I didn't catch the website. It's Ronke speaking.
Hi.
Yeah, I was just saying I didn't catch the website. Sorry.
Which website?
Slide 27. You wanted us to go surfing?
I'm going to log into the website for you
Oh,
now
okay. All right. No problem.
so that you will see what I'm doing. So I will start with, can we still see my screen?
Yes.
Hi, Ronke.
Hi.
It's Dr. Bello speaking. I just dropped a comment on the chat to
Okay.
everyone with the pension confusion. I know a lot of people are concerned about where their pensions are, but there's a current government project ongoing. At least I can develop that information. It's going to give everyone the access to like where their pensions are, because government is a bit concerned that pensions are being lost, like you said. So I know that the project started about 2 years ago. So estimated live date should be end of this year, but let's see how it goes. But it's going to be on like the normal gov.uk website. Once you put your NI number, it's meant to filter through all the pension companies and then show it to you.
That's amazing news. Thank you so much for sharing. That is amazing news.
Yeah. If so, one of the perks of being a research consultant, I work with different government departments.
Thank you. Because I think it's good, because if you know where your pay, I mean, I'm sure a lot of pension companies will not be too happy either, because
No,
now
no.
people are claiming their
They're
money.
fighting it, like they
Yeah,
fought
they will
it
fight
really
it
well.
because they're sitting on that money and investing it and reaping interest and pocketing all sorts. So I think it's a fantastic idea that the government is going to let people see
Yeah.
where their monies are.
I'm one of those that's rooting for it to be complete.
I am
I have
rooting
loads of pensions and I don't even
Now
remember
that
where
you
they are.
mentioned it. Fantastic. Okay, so can we still see my screen?
Yes, please.
Okay, so this is Agri's Lansdowne.
Yes, we can.
Yes.
Okay, so this is Agri's Lansdowne, and Good Money Guide has given them the best saving platform. I don't know about that. The website is very slick. There's a lot of information here. The US stock market under Trump, that's news. Tax-free investment returns. They're trying to teach you about ISAs. 45% tax relief. They're trying to tell you about the self-invested personal pension that I just told you about, that I just broke down to you, except that instead of explaining it, they have written a very long article that will take you time to understand. It's a very lovely website that I personally enjoy visiting. Now, if you go to the top here, on the first row, you will see Agri's Lansdowne, personal, workplace, register, watch list, help, contact us. Let's go through that. Personal, that's where your focus is. You're not a company. The workplace is for companies who are using Hargreaves for their workplace pension scheme. Personal is where you and I belong. And this is what we are looking at now. If you go to workplace, it looks completely different. So it's for workplace services for employees. That's not our business. We are going to stick with personal. On the right here, you can register. You need your NI number, your name, your address, and that's it. Watch list is meant for you to put in companies you are keeping an eye on. You know, if you go into your watch list, it will give you the opportunity to add a company, track investments. You can create a virtual portfolio and sync them, and you start a watch list. I'm not a fan of their watch list. I don't think it's great. I think Yahoo Finance has a better watch listing. Yahoo Finance sends me alerts when a stock drops to a price that I like, as in that price could be for just 10 minutes, and we know, and I can decide if I want to buy it or not. I've run out of parent-teachers meetings before to buy stocks. That's what Yahoo Finance will do for me. Now, you can contact them. They have a good contact system. You can call them. You can do all of that. Let's go back to what we can also do on this account. If you already have a stocks and shares account or any other ISA account, you can transfer to HL here. There's an option for you to transfer from whatever other platform you have. Now, the accounts you can have on the ISA, on this platform, you can have ISAs, the stocks and shares ISA, which is our main ISA that we like. You have the lifetime ISA, the cash ISA, and the junior stocks and shares ISA, which is for investing for children. The lifetime ISA they have here is also for investing for the first property or retirement. You can have pension accounts here. You can have a self-invested personal pension for yourself. You can have a junior pension for your children if you want to secure their old age when you're not here anymore. You can also have something to draw down existing pensions. The fund and share account is the account I want us to avoid because it's not tax efficient. It's a great account for people who are abroad, who are not UK residents, who want to have an account with HL. I have some clients who are living abroad and want to invest here. They do open accounts on Agris Lansdowne and they have fund and share accounts. You can have a savings account here as well. Sometimes their interest rates are good, sometimes it's bad. They have a good interest rate right now, 4.52, and their cash ISA is giving 4.5, which is nice. They don't always have that. Now, if you open a stocks and shares ISA account with them, you can transfer to them as well, but you can just open a straightforward stocks and shares ISA. You click on that button that says account, ISAs, stocks and shares ISA. You click on it, it takes you here. You open a stocks and shares ISA. They tell you what you need. You need to be over 18 years. You need to live in the UK, be a UK tax resident, log in to open an account. You choose a username and a password or date of birth. They will ask you for your NI number at the end of the day. That's the most important thing that they will ask you for. Now let's go to investing. So this is what is interesting here. I'm going to talk about the different things you can invest in as well. There is shares or equity, there is mutual funds, there are exchange traded funds, there are investment trusts which allow you to invest in real estate, there are venture capital trusts, there are gilts and bonds and things like that. Venture capital trusts, they will not usually allow you to invest in unless you go through some registration and they would ask you to deposit a large amount of money and so on, pass some questions because it's very risky and it's venture capitalism. You are investing in companies that are just startups. You are basically investing in startups. So that one, they will question you quite a bit. Gilts and bonds, I will also explain what that means. They are literally loans to government. But these are the things you can buy on Agris Lansdowne. And this is why I like Agris Lansdowne, because they have a lot of options. They also provide stock market data so that you can look at prices. You can look at prices. Let me give you a view of, say, a company like NVIDIA. You want to look at the prices for NVIDIA. They will tell you this is how much it will sell for if you want to sell it today. Today is a Saturday, so you can't sell today. This is Friday's price. As at 7th of February, the stock market is open Monday to Friday. See, they've told you here, market is closed. Market opening times is 2:30 to 9 p.m. because that's a US market. So NVIDIA is on the US stock market. It's a US company that is on the US stock market, which opens at 2:30 p.m. for us UK people to 9 p.m. So you sell at $129 and you buy at this. So you always pay a little bit more to buy than to sell. And then the price has started to climb up again. You can buy this stock if you have a stocks and shares ISA, if you have a lifetime ISA, a SIP, or a fund and share account. These are all the accounts you can use to buy this stock. Today, on Friday, the stock opened at 129.30. It closed at 128 the day before, increased a little bit. This is the highest it has traded in the last in the day, and this is the lowest it traded on Friday. These are the peaks. That's to show you how much the market moves in just one day. Can you see the movement? Can you see how much it's moving? Can you see why you can't stay here checking the price per second, because it's moving for you, it's moving, and it's market sentiment. So you trade high and trade low. That was the highest they got on Friday and the lowest on Friday, even though it opened at 129. It went high to 130, it dropped to 127. At some point around 4:30, you can see here, that's when it dropped to the lowest, and then it rose back up. In the last 1 year, some people bought at this price. Can you see? $66. At some point, that is the lowest NVIDIA got to in the last 1 year. So that the person that bought at 66, they've doubled their money. Their money is double as at today. This is the highest. Sorry, I didn't want to search. This is the highest it has gotten to in the last 1 year, or $53. And this is the market capitalization for this company. This is the number of shares it has issued. It is issued in dollars. Now, if you buy US shares, you must first complete a W8 bend form, which is a form that says that you have tax agreement with UK and US. If you don't complete this form, you will pay extra tax. So it's very important that when you buy US stocks, in fact, before you are allowed to buy any US stocks on this platform, they will make sure that they will request that you complete this form. Please don't ignore it, don't delete it, don't complete it. It's very simple, it's very straightforward. Go ahead and complete it. Now, the beauty of
Hi, it's Tolu. Quick question. Do you have to do the WUBEN for every company, or if you've got one already for
If
different?
you've not done it, but you have to
Right.
do it every year.
Okay.
Yes.
Thank
So look at this share price. This is 1 day. This is 1 week. Just 1 week. That's how much it's moved because DeepSeek is giving it, is showing it shaggy. This is 3 months. Now, can you see this dip? Can you see this dip in January? That's the kind of dip that my Yahoo Finance account tells me about. Do I wait for the dip to buy? No. If I wait for the dip to buy, I'm timing the market. We don't time the market. We buy anyway. However, you can set an alert and say if this price ever drops to 120 or 118, the extra money I have in my savings, I will use it to buy it. Do you get what I'm saying here? So you can invest regularly, but you can also invest when there is a dip if you are confident about the performance of that company. 1 year, 3 years. Can you see? Can you see how much money the person that has been here for 3 years has made? Now look at 5 years. Property market will never give you this. Forget what anybody will tell you. Historically, the property market has never yielded returns like the stock market. Because it's a tangible asset and people can hold it and they can see it and they can brag about it and they can tell you that they have 10 houses. They will tell you that it's giving them returns. It's never giving returns like the stock market. This is 5 years. This is 10 years. Can you see what is happening for the person that did 10 years? That is why we stay in the stock market and we bid our time. We wait and wait and wait until we get the returns that we need on the investment that we have made. So this is the dividend returns that is being given, 7%, 11, 24, 11, 75%. That's how it's been given returns. So this platform will tell you a lot of information about the market. They will give you news and insights as well. You can go to their news and insights page and see the news that is happening. Trump's tariff is shaking the stock market. What do you need to know? Interest rates cut to 4.5%. I have this news on my blog as well. If you go to my website, I've explained this interest rate cost to you as well. I explained the Nvidia drop as well. So you will always find information like that on my page as well. There's a lot of news about what are the most bought ETFs in January. Oh, that's an interesting one. We can look at it. When you want to invest in gold, you can invest in gold through ETFs. I've done a post about that. 5 shares to watch in 25. So there are lots of things you can learn from Agri's Lansdowne as a platform. So let's go to trading 212. And see that I
Ronke,
did.
it's Ronke here. Quickly before you move on, how do we know which companies to invest in?
I answered that question earlier.
Oh, I'm sorry, I didn't pick that.
You need to look at the company's performance, historical performance.
No. I understand that, but how do you know? What is it? Are the companies listed somewhere?
So companies are listed on stock exchange. That's actually
Oh,
a
okay.
question.
Yeah.
Companies are listed on stock exchanges. So you have
Okay.
companies on the UK stock exchange, which is called the FTSE, and you
Yeah.
have the US stock exchange, and then you have the Nasdaq, and then you have the Japanese, the German. So different companies have different stock exchanges that companies are listed on. So you can always get the list of the companies on any stock exchange.
Okay.
Yes. And then you have something called the FTSE 100, which is the largest 100 companies in the UK, and then the FTSE 250, which is the next one, 250. You have the US S&P 500, which is the largest 500. You have the Nasdaq 100, which is the largest 100 non-financial companies in the US. So you have those kind of indexes, and I will talk about the indexes a little bit more later on, that are in each country that you can use to measure performance of industries, of the country itself, of companies in that space, and so on and so forth. Does that answer your question, Funke?
Yes, it does. Yeah, it was in line with my train of thoughts, but I just thought it was just how you mentioned it in video earlier. I'm thinking, how did you know about that? Because I don't even know.
All right. Thank you very much. And apologies
Yeah.
for saying I've answered that question before, because clearly I didn't. It's a different question. So
Yeah.
thank you for asking. Delu?
Yes, thank you. You mentioned when you were because I think I asked this question earlier in terms of trying to know what you should be looking out for before you engage a particular company. Now, you mentioned this financial metrics sheet or something.
Yes.
So have you got a link to it? So
there's a link in the chat. I think Emmanuel put a link in the chat for us.
Oh, okay. All right.
So Emmanuel, please can you share the link again so that you can pick it up, because I think it's scrolled up quite a bit now. So we can get the link again. for us. And then I've also put in the link for the website as a whole, my website as a whole, so that you can see all the other products that are there that you can explore. Okay, so we have Trading 212. Now with Trading 212, you can buy stocks. You can invest very little money. They allow you to do fractional shares, which is normally not allowed in the UK, but somehow Trading 212 seems to allow it on their platform. Now, if you go here, they have something called CFD. This is not for you. This is for Forex traders. This is trading long, shorting, leveraging, all of those things. Stay away from that. See, they put a note at the top here, which a lot of people will miss very easily. They are complex instruments that come with a high risk of losing money rapidly due to leveraging. 76% of retail investor accounts lose money when trading CFDs with this provider. So this is, I don't know if they were forced to put this one there, but it's the truth. Stay away from CFD. Now, if you come here, they have a lot of information about their business, their share lending, pies, auto invest, all the other things that they can do for you. You want to go to the invest. This is what you are interested in, investing. Now, when they come here, you open an account. You click on open the account. I think they give you the Trading 212. They give you the stocks and shares option. Here, country of residence is UK. Then you tell them whether you want to open, see, they give you the invest first, CFD to trade long and short leveraged CFDs, and then they give you stocks ISA and cash ISA. The cash ISA here has very good interest rate at 4.9. I like it. The stocks ISA is what you are interested in. You are not interested in this first investing account. They are trying to encourage you to do it by saying, buy stocks and ETFs with zero commission. Yes, it's zero commission, but you will pay tax. Invest tax-free in a zero commission stocks ISA is what you want to choose. So you choose the stocks ISA and they ask you, I have an account here, but I can't remember my login. Then you log into the account and you start to invest with the Trading 212. Oh, I can't remember the password. I'm going to move back. Okay. And then that is it. You start investing with them. They also have articles that you can read. They have a lot of material here that you can read, but they don't allow you to really access their account unless you are registered, which with Agris, you can easily look at a lot of things. You saw me showing you a lot of things now without being registered, but these guys will make you register before you do anything on their account. The only reason why I like them is because they are regulated across Europe as well, not just the UK. So even if you're in Europe, you can use Trading 212 as a platform.
Question.
Yeah, go on.
Hi, Ronke, Tolu. So sorry, messages coming in distracting. So in terms of investment, you said the stocks and shares, but for someone that's maybe maximized their 20,000 for the year, for example, will that still be what you or suggest they do, or can they move to the other? I can't remember what the other icon was.
General account.
Yes.
If you've used up your stocks and shares ISA allowance, I would go and use my self-invested personal pension allowance
Okay.
because I still want to avoid tax. However, you don't want to put your money in a place where you can't reach it till you're 57, then yes, you would use a general account. But because I've also used up my allowance in the past. Sometimes I use up my allowance, some years I do, some years I don't. And the years when I do, I just move into my SIP and I start putting money in my SIP.
Okay. And equally, sorry, the 4,000, I had it noted down earlier that you spoke about the stocks and shares ISA, the 4,000, that's deducted from the annual allowance of 20,000.
Yes, if you have used your 4,000 in the lifetime ISA.
Okay.
Yes. So one thing I always do, and you don't have to do the same, is that when I use up my stocks ISA, I check if my children have used up their allowance. Because any money I invest for my children is money I'm saving myself in the future from having to give them. So I use up my own 20,000. Then I use up their 9,000. I have two of them. To be honest with you, I've never actually used up my 20 and then used up their two 9,000s because that's 18,000. And then if I use up my 20 and I use up my children's 9,000, I'll go to my husband. Have you finished your 20,000? Yeah, you don't have space. If I put 1,000 in, sure you will give me money.
I love the hierarchy from you
Yeah.
to your children and then to husband.
Yeah, but the problem with my husband is that he's a front loader. So while I like to spread my 20,000 and do like maybe 2,000 every month over 10 months or 3,000 every month over a few months, my husband will just upload his 20,000 in 2 months. He will load it. And then he will say enjoyment time. Baba is free. There is no extra. He's not interested in using any other allowance. Once he has used that 20,000, there's nothing I can preach in that house. He has done his investing for the year. It's time to go and use the rest of the money to play cricket. Anyway, so there is trading 212, and you can also invest there. You can buy stocks, you can buy ETFs. I just find this platform a little bit distracting. I need to show you Vanguard before I give you a break. My apologies, we have really used up a lot of time. And we need to move quickly because we've got quite a few slides to go. So Vanguard Investing is one of the accounts that I like a lot, but it doesn't allow you to buy stocks. You can only buy Vanguard products. Now, Vanguard also allows you to have ISA account. So you can see the Vanguard ISA is actually a stocks and shares ISA account. These are just very silly with how they just said Vanguard ISA. It is a stocks and shares ISA account. So it's a stocks and shares ISA account on Vanguard. You can open an account with them. It's for UK residents only as well. And you can also have a junior ISA for your children. It's a stocks and shares junior ISA. The general account is what you want to avoid. Then there is the pension account, which is the SIP as well. Now with Vanguard, you can buy ETFs, which are exchange-traded funds. I will go back to that and tell you about them. Index funds, retirement funds, which are portfolios, and life strategy funds, which are also portfolio funds. I'm going to take a break now, and we are going to come back. We are at 10:33. Can we come back at 10:40? That gives us 6 minutes to grab a cup of tea. Can we come back at 10:40, or should we say 10:45? What are we at?
10:45.
10:45. All right.
Yeah.
All right. See you guys in a minute.
Ronke, quick question before you dash. What time do we?
Welcome back from the break. We don't have a lot of time, so I'm going to breeze very quickly through the US tax efficient accounts. In the US, like I mentioned earlier, you have the 401k and the 403b, which are employer-sponsored retirement plans, and you put money in them through your employer before tax, which reduces your taxable income. So this is like our workplace pension in the UK, is what they have, is the 401k and the 403b, and sometimes employers match it. In the UK, employers are compelled to match or to contribute to your pension, so they have to do pension contributions, and they put the money into mutual funds and ETFs, and there's an annual contribution limit of, I think, $23,000 in the US. Now, if you don't have that, you can have the Roth IRA, which is also a retirement account, and is the closest to the stock ISA that we have. You contribute into it after your tax dollars, so it's money from your income after you've paid tax. So the same way we contribute to a stocks ISA is the same way they contribute to a Roth IRA in the US, and you can take it out tax-free at retirement, but their own contribution limit is $7,000, so it's not a lot. And people are eligible based on income levels, and you can withdraw anytime tax-free, but earnings are subject to rules. And then they have a traditional IRA, which is also like the Roth IRA, except that you can be tax deductible in contribution, so you can contribute to it before tax, but then you pay tax at the time of withdrawal. And of course, it's not as tax efficient as the Roth IRA. And in the US, in terms of which options are best, if you're in the US, you should always max out your 401k. Or both. If you are employed, then you go for the Roth IRA if you have maxed out your 401k. And then you also have taxable brokerage accounts, which you can open with the platforms I shared earlier as investing platforms for the US. Of course, they also have healthcare savings accounts and education savings accounts called 529 plans, which you can have for your children. And as long as you use it towards education, it is tax-free. And that is tax efficient investing in the US. If you are US based or if you're a dual nationality, your situation is quite complex, and you should speak to a tax advisor before you do investing across both borders. I won't go through Canada. Okay, so investing instrument. This is the one that we are really interested in because we've already started talking about it. There are different investing instruments that you can buy. once you are registered on your investing platform and you have opened either a stocks ISA, a lifetime ISA, or a self-invested personal pension account. Now, when you invest in stocks ISAs or in stocks and shares, it gives you part ownership of the company. So it's a little bit like a pizza, a round pizza. Consider a round pizza as the whole company. And then when you buy a stock of a company, you are getting a slice of that pizza. You are saying, I believe in you so much, I'm going to give you some money to do your business so that I can get a slice of the pizza. You guys have completely switched off cameras. Please switch on your cameras. I need to see the people I'm talking to. Even Grace is eating and her camera is still switched on. Consistency in spite of feelings, consistency in spite of the market, consistency in spite of the economy, consistency in spite of how you're feeling. Switch on your cameras, my people. Now, with stocks, the prices can be volatile because you are putting your money in one company. You are saying you believe in one company and you are investing in that company. So you believe in Microsoft, you believe in Amazon, you believe in Tesla, and you invest in it. It's volatile because if anything happens to that company, anything happens to your money. But if that company also grows, then your money will grow. The risk and reward are commensurate. High risk, high reward, low risk, low reward. And there are different kinds of stocks you can buy. Because like Funke said earlier, how do you know what companies out there? How do you know what to buy? The stock exchange tells you what companies are quoted on the stock exchange, what companies are there that are available for you to buy on the stock market. There are defensive stocks. These are the stocks of companies that are not easily affected by economic downturns. They provide stable returns and dividends because they sell or produce products and services that we use in spite of the economy. So National Grid, for example, it doesn't matter whether there is economy is doing well, economy is not doing well. We have to hit the house. We have to switch on light. The National Grid with National Grid. Coca-Cola, Tesco, GlaxoSmithKline, these pharmaceutical companies, people don't stop being poorly because COVID came. In fact, people got more sick. If the economy is poor, people are ill. If the economy is good, people are ill. So pharmaceutical companies, a lot of them are defensive stocks. When COVID came around, which is an example I like to give, people were going to the shops and we started baking. I don't know what correlation that had to do with the situation we're in, but people were baking. So people were stockpiling tissue. Tesco, Sainsbury's, Asda, these companies were doing well because they are defensive stocks. We don't stop eating because we have problems. In fact, we eat more. We don't stop doing those things. We might stop taking holidays. When you are broke, you'll be like, it's holiday the next day on my mind now. Please, let me go and boil rice. I can't kill myself. I've lost my job. Please, let me just eat bread first. Let me soak this bread with tea, and then we can come and talk about whether you will eat. That is why these companies are defensive stocks. While cyclical stocks are tied to economic cycles, they experience fluctuations in line with the economy. Ford, ITV, Marks and Spencer, Harrods, companies or things that we do when the economy is booming. They are impacted by poor economy. When the economy is not booming, they are the first things we abandon, and we think, no. Because at the end of the day, a lot of us have common sense. And they are there thinking, no, I can't do that right now. I need to eat. I need to pay my bills. So they're affected by cyclical economic cycles. Now, there are growth stocks. Growth stocks are from companies that you expect to grow revenue and earnings at an above average rate compared to other companies. They are not steady. You are looking for growth that is like this. You are looking for forward-looking growth. And some of us are always chasing those kind of companies. You're always looking for growth companies because you want to grow your money not beyond the average 5%, 8%, 9%, 10% that the market is going to give you. You want to grow at an exponential rate. Growth stocks are companies such that this year they will give you 10, next year they might give you 100%. A lot of them are technology companies now. Right now, the growth stocks are technology companies like Amazon, Apple, Meta, Alphabet, Nvidia, AMD, ASML, TSM, and so on. They are semiconductor companies. They are growth stocks. They will not pay you dividends because right now they are using your money to grow their company. They will increase in value. So that when you need money, you can sell their stocks. You can buy 3 units or 5 units. And in 3 years when you need money, you can sell 1 unit back and it gives you so much money. So that is what growth stocks do. You depend on their ability to grow rather than their ability to give you dividends. While defensive stocks are more likely to be dividend aristocrats. They are likely to give you dividends year in, year out because they are there, they are solid. Nothing is shaking them. It doesn't matter what happens. Now, that is what happens when you invest in stocks and shares. Now, I'm going to mention 3 stocks with 20% average annual returns in 20 years. Normally, if you see me on my Instagram, I will tell you that the stock market will give you annual return of 9%, 10% is a lie. I say that because we have analyzed over a large amount of stocks, including the ones that did badly and the ones that didn't do badly. There are some stocks that have returned 20% every year averagely for 20 years. Nvidia has done it, Netflix has done it, Amazon has done it, Apple has done it. In fact, Amazon has returned 31.78% annualized every year. So if you had put in 6,000 pounds into Amazon 20 years ago, you will have a little over 200,000 pounds now from your 6,000. If you had put in 6,000 pounds into Amazon 20 years ago, and you didn't add anything to it, you just put in 6,000 and you walked away. Today, you will have 230 something thousand pounds from just Amazon. Same thing with Nvidia, same thing with Netflix. In fact, with Nvidia, you probably have like 400,000 pounds. That's to show you that there are stocks that will perform beyond that 8%, 10% I would like to say is the average. That is if you are buying total funds. And if you willingly do your research, if you sit down and you do the research and you look at the companies and you keep your ears open, buy what you use. Buy what you use. If you are someone that works in the NHS and everywhere you turn, there's a product you are seeing. Everywhere you turn, there's a brand you are seeing. Buy it. Dr. Winnie just told us that she's a research consultant. She had information ahead of the room. She had information ahead of all of us about something that's some of you here have information. It's happening in your presence. You know. You are doctors and you are prescribing a particular medication all the time. Go and find the name of that company. Do your research. Find out what they are doing. They've found a new cure for sickle cell. What's the company that's done it? Who's done it? Who's funded it? Who has the contract to supply it in the UK? Who's going to be at the back of it? Who's supplying it to United Nations? Who's supplying it to the US? Find out, do research, do homework. Don't just doom scroll every day. No, do your research and find your next unicorn. In addition to you investing broadly. Now, what have I done? I have also done some research. I've looked at companies that I think have good potential over the next 10 years. I have them on the right. The companies that I've looked at and I've thought, okay, these companies I think will have projection. These are what analysts have defined as the 10 stocks that have strong growth potential in the future, which means a lot of these companies are not just my analysis. It is what analysts across the financial space have defined as companies that are likely to give you strong potential in the future. The last two companies are companies that I have added. DocuSign is a company that I think is going places. It's owned the space where we sign contracts digitally. Everywhere you go, you see DocuSign. It's old. It's held itself for a few years. I think it's going to do well over the next few years. App Loving Corporation is a company that develops apps and programs, and I think it's doing fantastically in that space as well. In fact, analysts have projected a 300% growth for App Loving this year, 300%. So these are companies that you can research yourself and decide what you want to invest in. Am I invested in all of these companies? No. Full disclosure, I don't have any singular Meta stocks. However, I'm invested in Meta heavily through funds, but I don't have any Meta stocks. The others I do have as individual stocks. In fact, my exposure to Nvidia, Microsoft, Amazon, and Google are quite heavy, and Apple, those first 5 stocks I am heavily exposed to. If the 5 of them have problems, I will have problems. So that's how much I'm exposed to the 5 of them. So this is what happens when you invest in stocks. Deolu has a question.
Thanks. Talking about analyst, because the day I decided to, come into this space and to start kind of trying to see investment. Even the first time I came across, I was a bit skeptical, because most people, Instagram, Facebook, on there, sometimes they are biased. They might be sponsored, sponsored people by companies just to draw traffic to their products. And so when you are listening to this analyst, how do you sieve out who is right, who is wrong, who is saying the right thing, who is saying the wrong thing? Because, for instance, for me coming to you, I've followed you for like 6 months before I decided, okay, I think I should give you a try because I think you are genuine. And compared to others that I've listened to, I just know that they are noisemakers and they're just out there to kind of make money. Thanks.
Okay, so you have to bear in mind that I'm very conservative. So if you're attracted to me, you have to bear that in mind. attracted to me in the financial investing. I'm very conservative, so you will not see me talking about in sexy companies, first of all, and the way I filter out analysts, I don't listen to social media analysts. I don't listen to social media analysis. That's the first thing. I do not. I listen to analysts that have financial education. So you need to be a chartered accountant or a CFA or one of those things. You need to be working in a financial analysis space. So I know that you're coming in contact with this information regularly. Your information needs to gel. So I will read your analysis and I will ask myself why. Your reasons for giving me the analysis, I will cross-check on other platforms. I will look at those metrics that I talked about. I take time to look at it. I check the stock market every single day. Not because I'm looking for anything specific, because I'm looking for something to jump out at me. And it will jump out at me only if I go there regularly so that I know when something is different. If you look at something on your table every day, the day that thing moves, you will notice because you look at it every day. So that's how I look at the stock market. I go there every day. I have alerts for about 45 companies that I'm just watching. Sometimes I don't even have money. I don't have money to put in, and that's full disclosure. I don't have money. I've used my money. My husband is giving me side eye and saying, "Auntie, you have done this month's investing. Please allow us to have food," because sometimes I have invested stew money, and I'll tell you guys, eat sandwich today. There's no stew. I've invested the money. Other people buy shoes. I buy stocks. So sometimes I'm watching and waiting. Do I know 100% what companies to buy? No. Honestly, I'm being completely honest with you. There is no magic mirror that tells us. Sometimes analysts are wrong. Sometimes they are wrong. And that is why if you see a lot of honest social media financial influencers who are not doing the research, they will tell you buy funds. Just buy index funds, buy total world funds. If you buy total world funds and you buy all those investment funds, will you make money? Yes, 8%. You will get the average 8%, you will get the average 9% of S&P 500 and total world fund, because S&P 500 will buy you not just those top companies which they heavily expose you to, but they will buy you all the other ones that might not do well, that might do well. Same thing with total world funds. They will invest your money quite wide. So they will offer you diversification. Do I have money in those things? Yes, I do. It will be foolish of me to put all my money into stocks. So I buy funds as well, especially if it's a market that I'm not so positive about, or I feel like it's not a market that's not going to go. I will buy the fund instead. That gives me a wide exposure within that industry. But when it comes to specific stocks, I sit down, I do research, I'm very conservative. I look at the product. If I don't understand the product, I don't buy. Which is why it took me quite a while to buy NVIDIA. Because I kept doing the research and trying to understand it and what is it exactly. So if AI doesn't work, what's going to work? I understand. Amazon, I have owned for years because I understood Amazon. Once I started buying nappies, I was like, nah, it's over. This company is going places. Forget it. They are delivering to me like, no. I cannot be the only one who benefits from Amazon this way. So that's another thing I do as well. I buy what I use. Mutual funds. So I've been talking about funds and I've talked about, how they give you a basket. Now, mutual funds, think of a hamper basket. Think of it like this. Grace has 200 pounds. She wants to buy stocks. Abby has 200 pounds. Ebere has 200 pounds. Olutoday has 200 pounds. But your 200 pounds cannot buy all the stocks you want, because all of you want Amazon, you want Microsoft, you want Tesla, you want Meta, because you've listened to me. So all of you pull your 200 pounds on this call and you give it to me. And then because you've put your 200 pounds, we now have what? 4,000 pounds, because there's 20 of us. And there's 4,000 pounds. And now, because I'm your fund manager, I will buy you a little meter, I will buy you a little Kogo, I will buy you 5 or 6 or 7 different stocks and tell you that because you gave me 200, you now have 10% of this, you have a fraction of all of those things. That is what mutual funds are. So mutual funds pool money from multiple investors and then put it into a diversified portfolio of assets. And they are actively managed by professional fund managers. So in this case, I'm your professional fund manager managing the funds by all of you. I have to be registered. I have to have certifications. In fact, if you go to a platform and you look at a mutual fund, they will tell you the name of the manager. They will tell you what city he lives in or she lives in. They will tell you what university they went to and what degree they did, because they want you to know who is managing your money. Now, because there's an active manager there, they are usually a little bit more expensive than the next kind of fund I'm going to talk about, which is exchange-traded funds. The aim of a mutual fund manager is to beat the market. So they are not going to buy the whole market. They're going to buy the funds or the stocks that they think are the best performers in that particular sector. So if your mutual fund is a technology fund, they're going to buy specific technology companies, and then they're going to be moving it and adjusting the portfolio, buying more here, reducing that one. Oh, we buy more Tesla, or we reduce AMD, we'll buy more ASML, because they're trying to beat the market. They are studying the market to see what they think will be the future, and then they will move into it because they want to beat the market for you. Because their ability to beat the market also influences their own fees, because they take a percentage of your profit. So the underlying funds is what you want to look at when you look at a mutual fund. What index is it tracking? What industry is it focused on? Is it technology? Is it AI? Is it robotics? Is it healthcare? How much is that mutual fund manager going to collect? How diverse is the portfolio? Is it buying just 10 things, or is it 20 things, or is it 50? What is in that portfolio? That's what you want to check when you buy a mutual fund. Exchange traded fund is the other kind of fund that I really like, and I prefer it to mutual funds. I think I shared a video recently that I said I don't buy mutual funds anymore because I found that a lot of them don't actually beat the market and they still charge those fees. With exchange traded funds, the fees are low, they're usually quite diverse, and they track a specific portfolio. So there's transparency. You know exactly what's in it. Because if they tell you that your index fund is a S&P 500 fund, then you know that it's buying the top 500 companies in the US. If it's a FTSE 100 fund, it's buying the top 100 companies in the UK. If it's a NASDAQ 100, it's buying the largest 100 non-financial companies in the US. So exchange traded funds are a big thing for me because, one, they allow me to diversify my portfolio. They allow me to buy a diversified list of assets in a particular industry or sector. If I want to buy oil and gas now, and I don't want to buy Shell, Chevron, BP, I'll just buy an oil and gas fund. And with £500, I've bought all of them. Bush, I'm going. If they do well, I benefit. If they don't do well, my risk is diversified. All of them will not collapse at the same time. If all of them collapse at the same time, it's an industry thing, it will recover. So technology, semiconductors, defensive, all of them you can buy as ETFs. You can even buy your bonds as ETFs. You can buy real estate investment trust as ETFs. A lot of things. Think of your ETF as a hamper basket. Some hamper baskets are food hamper baskets. When we were young, my dad would get hamper baskets at Christmas. And some people will buy them food hamper baskets, and it will have all sorts of nice things, chocolates, it will have milk, it will have all sorts of nice snacks and biscuits in it. I love the people that send food hamper baskets. And then some useless people will buy you toiletry hamper baskets. That will belong to my mom. It will have all sorts of napkins and hand cream and all of those things in it. So the hamper baskets have different focuses. That's the same way ETFs and mutual funds have different focuses. And you need to know what your ETF is focused on. What are the fees? Is it tracking an index? What's the historical performance of that ETF? Now, I wanted to share with you, feel free to take a picture of this particular slide. That's the benefit of paying for this class. These are my top exchange traded funds. I'm invested in quite a number of them. I will run through them very quickly for you. The first one is probably the most popular exchange traded fund, the world. Is an S&P 500 fund, which means that it's invested heavily in the largest 500 companies in the US. It's not the only S&P 500 fund out there. I've got two that I buy. The Vanguard one I've bought, and the SPX5, which is I think an SPDR S&P 500 fund, and both of them have returned the same. So you don't need to have two different S&P. I do, but you don't need to have two because they return the same thing. They return the same investment. They are investing in the same companies. They are just having slightly different fees. I used to be an SPX5 person before I fell into the Vanguard one and found out that it has lower fees. So I started buying the Vanguard one. I didn't sell my SPX5, held on to it, but I've got the Vanguard one. The fees are lower. Now, the second one is called the SWIDA, which is a fund that invests you across the developed world. The whole Europe, UK, US investing is developed world only, but the whole developed world. So instead of exposing you to just UK, is US, is Australia, is what they consider the developed world. That means there's no Africa in this portfolio, and I don't think there is even Asia in it. It's strictly the West. So the SWDA is a well-diversified total world fund, is a world fund, and is performed historically superbly. So I do have some of that as well. Another world fund on this list is the number 4, is the VWRP, which comes as income or accumulating. The number 1 also comes as accumulating an income. What I mean by accumulating an income, accumulating means when your money returns, when there is a return on it because there is the value increases or there's a dividend payment, they reinvest it for you. So it's accumulating your money. It's not paying it out. Income means when there is a dividend, they pay out dividend. You will find a little money in your account. You just find something piling into your investment platform savings account because they are paying dividend. I don't want any income yet because I'm still working. So I always buy accumulating, which will invest my money for me. So if you find a fund that has the same fund named twice, and you're thinking one has income, one has accumulating, what's the difference? That's the difference. Income will pay out dividend, accumulating will reinvest your money for you. So number one has both income and accumulating version. Number 4 also has both income and accumulating version. Now, number 4 is very similar to number 2. But I prefer number 4 for one reason. Number 4 is the actual total world. It includes emerging markets. So it includes Asia, it includes South Africa, it includes really big companies. Over 100 companies are there. The VWRP, which is the accumulating version, is something that I invest in quite a bit. Anytime I have money and I don't feel like investing in any of the normal stocks I buy, I will buy I'll just throw it in VWRP. For my children, I do a lot of VWRP as well because it's the whole world. And if there's something happening in Japan, recently they said they found some oil in Japan seas that is more than all the world across the whole world, blah, 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 and they're trying to find a way around it. If they find a way around it and Japan rises up to be a world power more than it is, I will benefit through my VWRP. I wouldn't benefit through VUSA or VUAG or through number 1 and 2 because those are ones I'm not invested in developing emerging markets. So you have number 4 as an emerging market, as a total world fund. Number 3, you have as a NASDAQ 100. So you invest in the largest 100 companies in the US that are non-financial. So a lot of the companies in number 3 are tech companies. So the Amazons, the Metas, the Nvidias, they are all in that number 3. So if you don't want to buy one of them, you can just buy EQQQQ and you are inside. And I'm always going to EQQQQQ. That fund will get you all of that. Then you have the also S&P 500 information technology. So it gives you the largest infotech companies in that top 500 list. So instead of investing you in all of the 500, is investing you only in the tech companies in that 500 space. The IITU is very similar in carriage to the EQQ. It's very similar. And then you have the number 6, which is the Vanguard FTSE 100, okay, which invests you in the largest 100 companies in the UK. A lot of those companies are dividend kings. So you get a lot of dividends from investing in that particular one. Number 7 is riskier because it puts you into emerging markets. If you're somebody who has a strong belief in Africa's emergence and Africa going places and all of those things, number 7 is your guy. Number 8, they are the dividend aristocrats in the US. The Walmarts, the BRKBs, those companies, Targets that pay dividends, the T-Mobile. Number 8 will give you exposure to dividend aristocrats. If you are somebody who wants to invest in property, but you don't want to have landlord issues, but you want to invest in property and you want to invest in commercial property, not residential, not just tenants in 2-bedroom flat. You want to be the landlord for Tesco. You want to be the landlord for NHS Trust. You want to be the landlord for malls. And you want to do it through real estate investment trust, but you don't want to buy just one. Because there are individual real estate investment trusts that you can buy, and I will show you that later on. Then you can buy the iShares UK Property UCITS ETF. Number 9 is the largest real estate investment trust ETF in the UK. I love IUKP. I love it. Then there is automation and robotics at number 10. And then there is gilts. If you want to buy bonds, I will talk about bonds later on. But number 11, 12, and 13 are bond ETFs that allow you to buy a basket of bonds instead of buying just one bond. I will move on. I'm not giving you a break. Okay.
Too fast.
Sorry.
Okay. Yeah, okay. Hopefully we'll get to review that again. But yeah, that was good. But yeah, it was a little too fast.
What was it? Let me go back.
So number 8, I think I was just clarification on that one, if possible, please.
Yes. Okay, so number 8 is the dividend aristocrats that fall within the largest 500 companies in the US. So in that largest 500 companies in the US, the S&P, which is the index, has defined some companies as dividend aristocrats. What that means is that they pay dividends. They come forth with the dividends. They are strong, they are stable, they are defensive stocks. They are not Tesla or Amazon or Meta that don't pay any dividends. They are large and they pay returns. If you are looking for income from US companies, number 8 is where you go. You buy those companies, you are assured of some dividend at the end of the year from most of them. And if most of them are in that number 8, it's likely that USDV will pay you dividends. So it's an income generating ETF.
Okay,
Does
thank
that
you.
make sense?
Yeah.
Other questions before I move forward from this?
Yeah,
now?
quickly, it's Ronke here. For this one, do you have to complete that WeBend form that you mentioned?
Yes. So
Okay.
for the US fund, you will complete the WeBen form. Yeah.
Okay.
Quick question, please. This is Tess. Can we buy this on all those platforms as well? Like, okay. I've seen your face, so
So the ones that have Vanguard in front of them, that's number 1, number 4, number 6, and number 13, you can buy on the Vanguard platform.
okay.
All the other ones you can buy on Agris Lansdowne and AJ Bell for a
Okay.
fact. Those are the 2 platforms I know sell everything. Every other platform, you just check. If you type it in and they have it, they will say they have it. If they don't have it, they will say not found. Then you will know that they don't have it.
Thank you.
Does that make sense? Okay.
Okay, just one more question. Is it in order of priority, the way you've listed it, in terms of your best?
There's something going on there, in the sense that I have preferences, and the first 4 are like my go-to.
Okay.
Okay, so but like I said, if you are buying number 2, you shouldn't buy number 4. They do the same thing. If you're buying, so like that. If you're buying number 3, you shouldn't buy number 5. They kind of have the same mix. If you see where I'm going with that. But what I've tried to do is cover as many different areas as possible. So if you want exposure to the UK, number 6 is good for that. If you want just exposure to property, number 9 is good for that. If you want just bonds, then number 10 to number 11 to 13 are good for that. I wouldn't buy 12 and 13. You see, 12 and 13 are similar. I put them there because they are from 2 different platforms. So if you're a Vanguard girly, number 13 is what you go for. If you're not a Vanguard girly, then you might look at number 12. There's an alternative to number 13. Does that make sense?
Okay.
Super. Okay. So with bonds, this is a great investment for people who have low risk tolerance because it's a fixed income investment. You lend money to an entity such as a government or a corporation in exchange for periodic interest. At the beginning of buying a bond, they tell you exactly what interest you are getting. Short term is called treasury bills. In the UK, we call them gilts. In the US, they call them treasury bonds. In Germany, they call them bonds. And it's relatively stable, very low risk. It's backed by the UK government and the US government for wherever you're buying it. 2 countries have never defaulted on a bond promise, and it's the UK and the US. If you buy a UK bond, you will get your money at the end of the period. It's just that the interest is low because it's low risk. They're telling you that you're not going to lose money. It's a loan. We don't need your money. And if the government is doing very well and they're not cash trapped, then your bonds will even pay lower interest rate because they're like, we don't need your money. If you want to give us a loan by force, no problem, but it's 1%. Now, in addition to gilts, you can also buy premium bonds. Premium bonds are a different kind of bond, and it's you saying, I want to save my money in the same savings account as the UK government. You are using the UK's government's national savings and investment account. It's like saving money with the government. It's not really a loan, which is why it's 0% interest. They don't pay any interest. Like, I don't want to save money in our hand. Bring it, we save it, but we're not paying you anything. Why? Because premium bonds are safe. They have outlasted 2 world wars. Premium bond, NS&I was registered or started before the First World War, and it's still here today. It's very popular with older British people. If you touch any 80-year-old British person and ask them, they'll tell you that they have premium bonds. They register in the lottery every month, and you can win up to £1 million. I remember the first time I got a winning notice from premium bond NS&I. Let's just say it was God that saved me before I sent a stinker message to my manager to say it's over between us. I'm not doing it again. It's not me, it's you. Because their message is always titled, you have won money. You didn't win 1 million. They just say you have won money. I said, let me type that email to my manager now and say toxic mother. Toxic son of somebody is over. When I opened the email, it was £50 I won. It was £50. So you can win £25, you can win £50, you can win £100, you can win different amounts. But the goal, of course, is the £1 million. Once you guys see that I delete my Instagram account and I'm not asked, I just say it's over. It's been nice knowing you guys. I loved it here. Fantastic. I won money. I have won the 1 million. Once you see that Ronke has gone, that's it. Because if I stay, I will start sharing the money with you guys. I will start doing, oh, Olutoday is such a friend. Let me give him 5,000. Oh, Grace was such a wonderful. No, I will just disappear before you guys appeal to the better side of me. So there is opportunity for you to have premium bonds as a savings account. I use this as a savings account because it's not a steady place to save money. So if I have savings account or money that I want to save, I want to access, I don't want to use up my ISA allowance by using a cash ISA to save, I will save it in the premium bonds account. It doesn't give you any interest. I can go back and pick up the money. If you ask me to hold money for you and I don't want to invest it, I'll put it in my premium bonds account because it increases my chance of winning the £1 million. There is also opportunity to buy US Treasury funds, and you can buy that through treasurydirect.gov, but I don't buy US Treasury bonds directly because I prefer to buy bond ETFs. So I simply buy US bond ETFs instead of going through the trouble of getting Treasury Direct Gov money, which is not tax protected. UK gilts are the way you buy bonds in the UK. That's how you invest in bonds. You can buy them through bond ETFs, which I mentioned earlier, Vanguard. You can buy them through AJ Bell. You can buy actual bonds through AJ Bell and Agris Lansdowne as well. You can also buy actual bonds through the UK Debt Management Office, DMO. And if you see on the right, that's how they present the bonds. They will tell you that it's Treasury, 2.5%. This is the due date. This is the coupon you are buying, but the interest rate, this is when it matures, and this is the price today. If you buy it, that 2.5% is annual interest rates. So if it matures for you in 3 months, they will prorate it. So they will divide it by 4 and you will get divided by 4 interest rates. So you see where I'm going. So from the beginning, you know exactly what you are getting with treasury bonds, but with bonds. But if you buy the bond ETF, there's no maturity date. It will mature in your portfolio and it will be switched out with something else, and you continue to go and you continue to go, and there's no need for you to cash out, which is why I like to buy bond ETFs, because it's like a hamper basket for me. The other kind of investment you can do is real estate investment trusts. We are really running out of time, but it's fine. Real estate investment trusts allow you to invest in real estate, whether it's commercial or residential, without you having direct ownership and still protecting you from tax because you do it through your stocks ISA. Because if you buy property as a landlord, you are not protected from tax. You will pay, you will do returns on that account, you will show how much you earned, you will get some tax relief on your mortgage interest, but really you will still pay tax. But with this one, you can buy them on the stock exchange like every other stock. You can also buy REIT ETFs, which I gave you one already, the IUKP, and you get rental income and capital appreciation. And the UK government requires these companies, REITs, to pay 90% profit back to stock shareholders. So they are not allowed to say we are reinvesting your profit. They have to pay out 90%. Now, the benefit of real estate investment trust is that they have more money to buy big real estate. They have more money to do commercial real estate where the real money is, not the one that you'll be dragging 2-bedroom flat with tenant that has not paid you in 6 months. They have real money and they can buy bigger property. They can also benefit from size, the benefit of size when they repair their property or when they maintain their property, because the rate that the plumber will give you for your 2-bedroom is not the same rate he will give a company that he knows is going to give him 20 houses to plumb. So that benefit is then passed on to you as interest. So this is why I'm a big fan of real estate investment trust. However, I have to tell you, the real estate market is not a high yield market presently. It's not a growth market. It's not a market that will give you 10% annually or 20% annually. Bear that in mind. It's a 3% to 6% market. So it's very important that you bear that in mind. Historically, it will give you something between 3 and 6%. But if you're somebody who likes real estate because it's a steady market and you want to diversify your portfolio, it's definitely an option for you to consider. Commodities, where my girl is. If you're somebody who likes gold, and you want to invest in gold, and I did a video about this recently, you can also buy gold ETFs. You can invest in gold mining companies. And that way you have exposure to gold to diversify and edge your portfolio. Because when the rest of the stock market is doing badly, is when gold does well. So that you have something that is climbing when other things are dropping. When other things are climbing, gold will just be there. It won't drop, but it won't give you a lot of returns. So it's a great way to diversify your portfolio. However, it's also volatile. It's influenced by economy, geopolitics, weather conditions. Everything also impacts this one because of where it is mined from. It's a tangible asset with intrinsic value. If you don't want to buy it on the stock market, you can also buy actual physical gold bars. There are companies that are regulated in the UK that sell bullion bars, and you buy it, they also store it for you and charge you a storage fee, so that you don't have to take it home and risk being visited by the people that need it more. Gold ETFs. I didn't have any on the list, but there are some. When I email you today, let me take a note of that. I will send you some gold ETFs. I will put some in the email for you. I've also shared some on Instagram before, but I will put them on my gold ETFs in the email I sent to you after this call, so that you can explore that as well for you. So yes, you can buy gold as bullion bars, and you can also buy gold as jewelry. However, just bear in mind that when you buy gold as jewelry, you are paying for the gold at spot rates, but you are also paying for artisan fees, because somebody is designing the gold you are wearing and making a design, and an artisan is breaking it up and doing it. So you are paying for that as well. However, I will still pick gold jewelry any day over costume or jewelry that has no retail value, because your gold jewelry definitely has retail value. Okay, we don't have this. Okay, all right. This is the fighting slide. Can't escape it. We have 6 minutes, but I want to go through my fighting slide. Your car is not an asset. It's not an investment. It's a depreciating asset from a strictly accounting point of view, which means if it's a business tool, if you've bought it as a property of your company, you can depreciate it over a number of years. That's the only time you should even put a car on or buy a car for asset purposes. Then you can depreciate. And a company car, you can't buy a Rolls Royce. They will check you. HMRC will check you, because why is your company car a Range Rover? They will check you. It's supposed to be a tool of work, not a luxury car, which is why I said luxury cars are not assets, or they are not investments. Timeshare properties, don't even touch them at all. Not your business. Satan, the number you are calling is not available. Once they bring the timeshare property, just block the person. They don't even like you. Designer clothes, accessories, high-end jewelry, wear them, enjoy them as expenses. Rewards for good labor. It's fine to treat yourself. They are not investments. If you need to justify them as investments, you shouldn't be buying them. If you renovate your home, I don't know why homeowners continue to argue this one. If you renovate your home, that's your business. You have renovated your home for your own enjoyment. It's not an asset, it's not an investment. The house is an investment. The home that you have bought is an investment. The renovation you've done is not, because the person that's going to buy the home after you will not necessarily like this very red carpet and the very red bathtub that you have put in. So they have to do something. In fact, it can sometimes depreciate or reduce the value of that asset. So your home renovation is a personal taste thing and is not an investment. This same thing applies to high-end electronics and collectibles that don't have demand. All of these things are not investments. Yes, you need comfort. You can enjoy it. You should do them for your own benefit and your own comfort. And you should bear them in mind. They are just expenses. So in your books, you should not borrow money to do them. That's where I'm going. That's where I'm going. You need comfort. Save up for your red bathtub. That jacuzzi, save up for it. But if you take a credit card or you take a loan to renovate your house, you are making a funny move, because it's not an investment. You're not going to make that money back. So you have gone into debt for something that you're going to have to pay off. It's the same thing as going into debt for a holiday. Do we need holidays? Yes. Holidays are great. We need them time to refresh and recharge. But should we go into debt for holidays? No. But can you go into debt for an investment? Absolutely. You can take a mortgage and take a mortgage out for a second property. That's a good debt because it's tied to an asset. Do you see where I'm going with this? Now, quick test, because I know some people were yawning through this class. Some people were doing all sorts of things, stretching, they were having side conversations. It's time to check which if your camera is on, the reward for your camera being on is that you don't have to answer any question. Now, my people who didn't switch on cameras, which investing instrument is a loan to the government?
Bonds.
Premium bonds.
Yeah, the bonds.
Bonds, gilt.
Bonds, not premium bonds. Bonds, gilt, yes.
Bonds,
Which
yeah.
instrument is managed by professionals and may have fees?
Mutual funds.
Thank you.
Which
You
one?
can buy this investment in physical form.
Gold.
Oh,
Thank you. Portfolio of assets that's traded on the stock exchange.
ETFs.
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 And in the
Thank you. What provides exposure to real estate markets?
REITs.
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 Wonderful.
We're following you now. Did you think we weren't listening?
Good go.
Well, listen. Well, listen. I'm proud of you. I'm proud of you. I'm proud of you. Okay, super. Okay. Yeah, somebody said if we put renovations under your limited company account, it helps with taxes. Yes. Yes, it does. It does. Absolutely. If you have an home office or if you have a company house, yes, absolutely, it does. You're right. Important points. Don't forget what I said. Research, research, research. Know your risk appetite. In fact, there are platforms that can help you check your risk appetite. Feel free to use them. Assess the instrument risk before you buy. Make consistent investment. Don't invest in January and come back in December. I showed you the graph. The market does this. The market moves like this. If you can see my hand, the market moves. It moves like this. It does this. So if you buy in January, you might be buying here. In February, it does this, you didn't buy. In March, it does this, you didn't buy. In April, it's like this, you didn't buy. Then in May, it's like this again, you went and bought. Can you see that you have bought at two high points when the market is expensive? But if you are buying every month, then you do January, February, March, April, May, June, July, August, September, October. Then you are buying at different price points in the market. Even if you have 20,000 pounds today and you want to use your allowance, put the money in your stocks ISA account, but don't make the purchase one day. Once the money is in your stocks ISA allowance account, it counts that you have used that allowance. You don't have to now invest that 20,000 in one day. Because remember, Nvidia was at a particular price, Microsoft moved a particular price, then they moved up, then they moved down. Don't invest in one day. If you have 20,000, do 3,000 today, 2,000 tomorrow, 5,000 next week, 3,000 another week. Spread it until you've done the whole 20,000. But put the money in your stocks and shares ISA as soon as you have it, and then start investing as you go. In fact, sometimes I stash the money there, do a little bit of investing, and then I wait for my alerts. And once my alerts start coming in, I just start investing that account and start going. And I spread my investing over a few weeks, over a few months until it's all done. I don't invest everything in one day. Diversify your portfolio. No matter how much you like a particular company, please don't put all your money into one company. That's putting all your eggs in one basket. We don't do that here. You spread yourself. You try different companies. You put a little here, you put a little there, you put a little there. Use your tax wrappers. Use your stocks ISA. Use your children's stocks ISA. Use your SIP before you go and start using a general account that offers no tax benefits. Take note of the financial year. It's from April 6 to April 5. That financial year is your business. You want to know when it starts and when it ends. Set an alarm on your phone. April 6th, the new financial year started today. All your alarms should not only be about prayer groups. You can set alarms for your investing as well. It's time to invest. Salary has come in. It's time to invest. I have the craziest alarms that go off on my phone. Once on my phone, my daughter will say, "What's that alarm again, mommy? What is it telling us this time?" Because it will tell you something. I have alarms for calling my parents. I don't have any shame. I don't have any shame. Call your mama. It's there. So that I can call her every week, because otherwise I'll get carried away with work and life and things like that. So take note of the financial year and be aware of when they happen for you. Bulletproof other areas of your life. So in addition to investing, it's important to stay on top of the other areas of your life. You need to build your emergency fund so that you are prevented from liquidating your investment. If you don't have emergency funds, when you need money, you will sell your assets, because you want to survive. So it's important that you have something stashed away. I mentioned earlier that I use my premium bond account for that. Stash something away to pay for emergencies that come up. Pay off high interest debt. Any debt that has over 7%, in my opinion, is a high interest debt. You have no business holding on to it. Pay it off. Establish payment plans for those debts, whether it's snowball, whether it's avalanche. Establish something to help you pay off your debt. Make pension and retirement plans. Make sure that you are taking advantage of your workplace pension so that you can get a free money from your employer. If you don't do it, they won't force you, because that way they don't have to pay you. So they've added the money to your employment letter. When they were telling you that they employed you, they were adding that money to say, this is how much we pay you, this is how much we pay you, to show that they pay you well. But you're not taking advantage of it. If you're over the age of 40 in the UK, health insurance is a thing. If your employer is not offering it, find something for yourself. Get health insurance. If you have children, get life insurance. So that if anything happens to you, your children are provided for. If you have a property, get home insurance. You should have home insurance in your property. It will stand you well. It will help you. Home insurance, I've saved my life a few times. It's important that you understand your cash flow. Know how much is coming in every month, because that's how you will know whether you have money to save or whether you have money to invest. Now, the one thing that is not on this spreadsheet or on this slide that I want to say to you is that there is only so much you can save. You need to make the money for you to invest. So if you have been in the same job for the last 3-4 years without pay rise, I'm looking at you. Why? It's not your daddy's company. That's a toxic employer. Do something about it. You are not a tree. The only things that can't move are trees. Even trees bend. You're not a tree. Pack your bags and go. Dust up your CV and look for the next job so that you can earn more and have a little bit more to invest instead of shouting cost of living. Because in the same cost of living you are shouting, some people are building wealth. So look into that. Look into side hustling. We all have skills that can be monetized. Find a skill that you can monetize if you feel that you're not in a position to change jobs. Because there are some people who are not in a position to change jobs for different reasons. I'm going to stop recording so that we can take questions a little bit more. Thank you so much for attending this class.